GEICO, the Gecko's Two Faces, a comprehensive analysis of America's second largest auto insurer. Introduction. In the vast landscape of American corporate giants, few companies have achieved the level of cultural recognition that GEICO has established through its ubiquitous advertising campaigns. The friendly green gecko with his charming British accent, the frustrated cavemen, and the memorable slogan, 15 minutes could save you 15% or more on car insurance, have become embedded in the national consciousness. Today, GEICO stands as the second largest private passenger auto insurer in the United States, insuring over 28 million vehicles through more than 16 million policies. Behind this remarkable success story and beloved public image lies a complex corporate history spanning nearly 9 decades. From its humble beginnings during the Great Depression to its current status as a cornerstone of Warren Buffett's Berkshire Hathaway empire, GEICO's evolution reflects broader trends in American business culture, insurance industry practices, and corporate marketing strategies. The company's journey from a specialized insurer for government employees to a mass-market insurance behemoth offers a fascinating window into how corporations grow, adapt, and sometimes fundamentally transform their identities and operations. Yet, as with many large corporations, a significant gap exists between GEICO's carefully crafted public persona and its internal practices. The friendly, customer-focused image projected through billions of dollars in advertising often contrasts sharply with the experiences of both customers and employees. This disconnect raises important questions about corporate authenticity, the ethics of modern marketing, and the sometimes conflicting imperatives of shareholder value and stakeholder interests. This essay examines GEICO's history, growth, leadership transitions, and cultural evolution with particular emphasis on the contradictions between its public image and internal practices. By analyzing these contradictions, we can gain insight not only into GEICO as a specific corporate entity, but also into broader patterns in American business culture. Despite its friendly, humorous public persona, GEICO's internal practices reveal significant contradictions that reflect deeper tensions in American corporate culture. Tensions between profit maximization and ethical treatment of customers and employees, between marketing promises and operational realities, and between the image of corporate stability and the tumult of organizational change. The following sections will trace GEICO's development chronologically, from its founding in 1936 through its periods of growth, crisis, transformation, and its current challenges. Throughout this narrative, we will examine how the company's public image has evolved alongside its business practices, highlighting the areas where these two facets align and where they diverge. By the conclusion, we will have developed a comprehensive understanding of how GEICO became the company it is today, the nature and implications of its internal contradictions, and what these contradictions might tell us about the future of both GEICO and American corporate culture more broadly. 2. The birth of an insurance giant, 1936 to 1958. In the midst of the Great Depression, when most businesses were struggling to survive and few entrepreneurs dared to launch new ventures, Leo and Lillian Goodwin embarked on a bold experiment that would eventually transform the American insurance landscape. The timing seemed inauspicious. 1936 marked the tail end of the worst economic crisis in American history, with unemployment still hovering above 15% and consumer confidence shaky at best. Yet it was precisely these challenging economic conditions that helped shape the innovative business model that would eventually propel GEICO to industry leadership. The Great Depression context and entrepreneurial vision. Leo Goodwin, an insurance industry veteran, had developed a revolutionary concept during his early career in Texas. He recognized a fundamental inefficiency in the traditional insurance model, the reliance on commissioned agents as intermediaries between insurers and customers. These agents, while providing personalized service, added significant costs to the insurance process, costs that were ultimately passed on to consumers through higher premiums. Goodwin envisioned a more streamlined approach, selling insurance directly to carefully selected customer groups who presented lower than average risk profiles. The economic pressures of the Depression made this cost-saving approach particularly appealing. Consumers were desperately seeking ways to reduce expenses, and traditional insurers, with their high overhead costs, were struggling to offer competitive rates while maintaining profitability. Goodwin saw an opportunity to disrupt the industry by eliminating the middleman and passing a portion of the savings onto customers, while retaining enough margin to build a profitable business, even with lower premiums. Leo and Lillian Goodwin, founding principles and innovative business model. With this vision in mind, Leo and Lillian Goodwin established the Government Employees Insurance Company in 1936. The name itself reflected the company's core strategy, focusing specifically on government employees as their primary customer base. This was no arbitrary choice. Goodwin had analyzed various occupational groups and determined that government employees, both federal workers and military officers, represented an ideal target market for several reasons. First, government employees enjoyed remarkable job stability, even during the Depression, making them reliable premium payers. Second, they tended to be well-educated and responsible, characteristics that correlated with safer driving habits and fewer accidents. Third, as a defined group with common employment characteristics, they were easier and less expensive to market to than the general population. This targeted approach allowed GEICO to achieve greater efficiency in both customer acquisition and risk management. Lillian Goodwin played a crucial role in the company's early operations, handling multiple vital functions, including marketing, accounting, rate setting, and underwriting. Her direct involvement in marketing to government employees helped establish the personal connection that would become a hallmark of GEICO's approach, even as the company grew beyond its original niche. The husband and wife team embodied the entrepreneurial spirit of their venture, working tirelessly to build the business from the ground up with limited resources but unlimited determination. The Goodwin's business model was revolutionary in two key respects. First, by selling insurance directly to consumers rather than through agents, they eliminated a major cost component that had long been considered essential to the insurance business. Second, by focusing on a specific, lower-risk demographic rather than the general population, they could offer lower rates while maintaining profitability. This combination of direct sales and targeted marketing would eventually become GEICO's competitive advantage, though it would take decades for the approach to achieve mainstream adoption in the industry. Early growth challenges and successes. The fledgling company faced numerous challenges in its early years, starting with minimal capital in a highly regulated industry dominated by established players. The Goodwins had to be resourceful and persistent. They operated out of a modest office with a small staff, focusing intensely on their target market and maintaining strict financial discipline. Despite these constraints, the business model proved viable almost immediately. Within the first year, GEICO had written 3,700 policies and hired 12 staff members, a modest but promising start. The company's growth accelerated during and after World War II, as the number of government employees expanded dramatically and military personnel returned home seeking insurance coverage. This period of expansion validated the Goodwins' original vision and allowed the company to build a solid financial foundation. By focusing on a specific customer segment and maintaining low overhead costs, GEICO was able to offer premiums that were often 20–30% lower than those of traditional insurers while still generating healthy profits. However, this growth also brought new challenges. As the company expanded, it needed additional capital to support its operations and meet regulatory requirements. The original investors who had backed the Goodwins' vision began seeking other opportunities, necessitating a search for new financial partners. This search would lead to a pivotal moment in GEICO's history, the involvement of investment banker Lorimer Davidson, and through him, the eventual connection to Benjamin Graham and Warren Buffett. The company's founding values and culture under the Goodwins. The Goodwins established a corporate culture that reflected their personal values and business philosophy. Frugality was paramount. Every expense was scrutinized, and efficiency was prized above all. This wasn't merely a financial necessity, but a core principle that aligned with the company's value proposition of passing savings on to customers. The Goodwins believed that by keeping their own costs low, they could offer better rates to policyholders while maintaining profitability. Innovation was another defining characteristic of early GEICO culture. The company's very existence was predicated on challenging industry conventions, and this spirit of questioning established practices permeated the organization. Employees were encouraged to find more efficient ways of operating and to focus relentlessly on the company's competitive advantages. Customer service, despite the lack of face-to-face agent interactions, was emphasized as a critical differentiator. The Goodwins recognized that to succeed with a direct-to-consumer model, they needed to provide exceptional service to compensate for the absence of local agents. This commitment to service quality would remain a core value throughout GEICO's history, though its implementation would evolve significantly over time. The workplace environment under the Goodwins combined the personal touch of a family business with the disciplined approach of insurance professionals. As founders actively involved in day-to-day operations, Leo and Lillian knew their employees personally and fostered a sense of shared mission. This created strong loyalty among early staff members, many of whom would remain with the company for decades. Analysis: how GEICO's founding principles continue to influence its operations today. The foundational elements established by the Goodwins, direct-to-consumer sales, targeted marketing to specific demographic groups, emphasis on cost efficiency, and commitment to customer service, continue to define GEICO's business model nearly 9 decades later. The company has expanded far beyond its original focus on government employees, but the core strategy of identifying and targeting lower-risk customer segments remains central to its operations. The direct-to-consumer approach pioneered by GEICO has become increasingly dominant in the insurance industry, particularly as digital technology has made remote interactions more feasible and consumer preferences have shifted toward convenience and self-service. What was once considered a radical departure from industry norms is now viewed as prescient, an early recognition of where the market would eventually head. GEICO's emphasis on cost efficiency also persists, though its manifestation has evolved. The company's massive advertising budget might seem at odds with the Goodwins' frugal approach, but it reflects the same fundamental principle: investing resources where they generate the greatest return. For the modern GEICO, the return on advertising investment has proven substantial, allowing the company to acquire customers at a lower cost per acquisition than traditional agent-based models, despite the high absolute spending. Perhaps most significantly, the tension between cost control and customer service that existed from GEICO's earliest days continues to shape the company's operations and culture. The Goodwins recognized that eliminating agents created savings but also removed a personal touch that many customers valued. Their solution, emphasizing exceptional direct service, established a pattern that GEICO has followed throughout its history, though with varying degrees of success. This founding tension helps explain some of the contradictions in modern GEICO's practices. The company's friendly, accessible public image attempts to compensate for the lack of personal agent relationships, while its internal focus on efficiency and cost control sometimes undermines the very service quality it publicly champions. This fundamental contradiction between the promise of both lower costs and superior service has its roots in the Goodwins' original business model and remains unresolved nearly a century later. The entrepreneurial spirit of challenging industry conventions that characterized GEICO's founding has also left a lasting imprint. The company continues to position itself as an innovator and disruptor, even as it has grown into one of the industry's dominant players. This self-perception as an outsider, challenging the establishment, persists in GEICO's corporate culture and marketing, despite its current status as part of one of the world's largest conglomerates. In many ways, GEICO's founding during the Great Depression established not only its business model, but also the core contradictions that would define its development. Born from the tension between economic necessity and innovative vision, between cost-cutting and service quality, between targeting specific groups and aspiring to mass market appeal, GEICO has never fully resolved these inherent contradictions. Instead, they have become woven into the fabric of the company, shaping its evolution through periods of growth, crisis, and transformation. 3. Growth, crisis, and transformation, 1958 to 1993. The period from 1958 to 1993 represented a transformative era for GEICO, encompassing dramatic growth, near-catastrophic crisis, and ultimately successful reinvention. These decades tested the viability of the Goodwin's original business model, revealed both its strengths and vulnerabilities, and set the stage for GEICO's eventual emergence as an insurance industry powerhouse. The company's journey during this period mirrors the broader economic cycles of post-war America, from the prosperity and optimism of the late 1950s and 1960s, through the turbulence and challenges of the 1970s, to the technological innovation and market evolution of the 1980s and early 1990s. The Davidson era, 1958 to 1970s. When Leo Goodwin decided to retire in 1958, he named Lorimer Davidson as his successor. Davidson was not merely another insurance executive. He represented a crucial link in GEICO's history. Having joined the company in 1948 as an investment banker and friend of the Goodwins, Davidson had helped secure new investors when the original backers sought other opportunities. Among these new investors was Benjamin Graham, the renowned Columbia University business professor and father of value investing, who would later introduce his student Warren Buffett to GEICO. Davidson's leadership style combined financial acumen with a commitment to the core principles established by the Goodwins. He maintained the direct-to-consumer business model and continued targeting government employees and military officers as preferred customers. However, he also recognized the need for physical expansion to accommodate GEICO's growing operations. In 1959, Davidson presided over the opening of new headquarters in Chevy Chase, Maryland, marking the end of GEICO's first 2 decades and the beginning of a new chapter. Under Davidson's guidance, GEICO experienced remarkable growth throughout the 1960s. The company passed the 1 million policyholder mark in 1964, a significant milestone that validated its business approach. Insurance premiums reached $150 million in 1965, and net earnings doubled to $13 million in 1966. This financial success enabled further expansion of services and facilities. GEICO opened its first walk-in sales and service offices for customers who preferred face-to-face interactions, as well as its first drive-in claims office in 1965. These physical locations represented an interesting evolution of the original direct-to-consumer model, acknowledging that some customers desired in-person service while still maintaining lower costs than traditional agent-based competitors. The growth during this period was not merely quantitative, but qualitative as well. GEICO expanded its product offerings beyond auto insurance, though this remained its core business. The company also began to broaden its target market beyond government employees, cautiously extending coverage to other professional groups deemed to present similar risk profiles. This gradual expansion of the customer base represented an important strategic shift, laying the groundwork for GEICO's eventual transformation into a mass-market insurer. Davidson's leadership coincided with a period of general economic prosperity in America, which benefited the insurance industry as a whole. Rising car ownership, suburban expansion, and increasing household wealth created favorable conditions for auto insurers. GEICO's low-cost model proved particularly attractive in this environment, allowing the company to capture market share from traditional insurers while maintaining healthy profit margins. The financial crisis of the mid-1970s. The 1970s brought profound challenges to GEICO that threatened its very existence. The decade began with the deaths of both Leo and Lillian Goodwin, marking the end of the founding era and perhaps symbolically foreshadowing the difficulties to come. Without the founders' guiding presence, GEICO entered a period of aggressive expansion that would ultimately expose serious weaknesses in its underwriting and reserving practices. The company's troubles stemmed from several interconnected factors. First, in its eagerness to grow, GEICO had expanded too rapidly into new geographic markets without fully understanding the different risk profiles and regulatory environments. Second, the company had gradually relaxed its underwriting standards, ensuring drivers who fell outside its traditional low-risk categories. Third, GEICO had failed to maintain adequate loss reserves to cover potential claims, a critical oversight in the insurance business. These internal vulnerabilities coincided with external challenges. The 1973 oil crisis and subsequent economic recession put financial pressure on many Americans, leading to changes in driving patterns and insurance needs. Inflation drove up the cost of auto repairs and medical treatments, increasing the average cost per claim. Regulatory changes in various states affected pricing and coverage requirements. Together, these factors created a perfect storm that pushed GEICO to the brink of insolvency. By 1975, the company's financial situation had become dire. GEICO reported substantial underwriting losses, and regulators began expressing serious concerns about its ability to meet obligations to policyholders. The company's stock price plummeted, and industry analysts questioned whether GEICO could survive. This crisis represented not just a financial emergency, but an existential threat to the company's distinctive business model. Critics argued that the direct-to-consumer approach had proven inadequate for proper risk assessment and management, suggesting that traditional agent-based insurers had been right all along. In this moment of crisis, Warren Buffett made his second significant appearance in GEICO's history. Having first purchased GEICO stock in 1951 after meeting with Davidson, Buffett had maintained an interest in the company. In 1976, seeing opportunity in GEICO's troubles, Buffett purchased approximately 1 million shares of GEICO stock. This investment provided not only needed capital, but also a vote of confidence from one of America's most respected investors, signaling that GEICO's core business model remained viable despite its current difficulties. Restructuring and recovery efforts. GEICO's recovery from the mid-1970s crisis required painful but necessary restructuring. The company brought in new leadership with expertise in underwriting and financial management. It withdrew from certain geographic markets where performance had been particularly poor. Most significantly, GEICO returned to its roots by tightening underwriting standards and refocusing on its traditional customer base of government employees and other low-risk groups. The company also strengthened its reserving practices to ensure it maintained adequate funds to cover potential claims. This more conservative financial approach meant sacrificing short-term growth for long-term stability, a difficult but essential trade-off. GEICO reduced its workforce, closed underperforming offices, and implemented stricter cost controls throughout the organization. These measures were painful but ultimately successful in stabilizing the company's finances. The crisis and subsequent recovery had profound effects on GEICO's corporate culture. The near-death experience instilled a deeper appreciation for financial discipline and risk management. It reinforced the importance of the company's original focus on carefully selected customer segments, and it demonstrated both the vulnerabilities and the resilience of the direct-to-consumer business model. GEICO emerged from this period with a stronger understanding of its competitive advantages and limitations, setting the stage for more sustainable growth in the decades to come. The 1980s, rebuilding and technological innovation. The 1980s represented a period of rebuilding and reinvention for GEICO. Having survived its existential crisis, the company focused on strengthening its core operations while cautiously exploring new opportunities for growth. Prudent underwriting prevailed, with GEICO maintaining strict standards for policy approval and pricing. This more disciplined approach resulted in slower but more sustainable expansion. A significant development during this period was GEICO's embrace of new technologies to enhance its direct-to-consumer model. In 1980, the company introduced 24-hour-a-day, 365-day-a-year telephone service for claims, sales, and service. This innovation aligned perfectly with GEICO's business philosophy. It improved customer convenience while maintaining cost efficiency compared to physical locations with limited hours. The round-the-clock telephone service became a competitive advantage, allowing GEICO to provide responsive customer support without the expense of a traditional agent network. The 1980s also saw GEICO begin to experiment with early computer systems for policy management, claims processing, and customer data analysis. These technological investments laid important groundwork for the company's later digital transformation. By computerizing core operations, GEICO improved efficiency while gathering valuable data that would eventually inform more sophisticated pricing and marketing strategies. During this decade, GEICO gradually resumed geographic expansion, but with greater caution and better risk assessment than during the pre-crisis period. The company also continued to broaden its target market beyond government employees, though it maintained higher standards for driver quality than many competitors. This balanced approach to growth, neither overly aggressive nor excessively conservative, reflected the lessons learned from the 1970s crisis. The economic and regulatory environment of the 1980s presented both challenges and opportunities for GEICO. The decade began with high inflation and recession, but transitioned to a period of economic growth and declining interest rates. Insurance regulation evolved significantly during this period, with states implementing various reforms affecting pricing, coverage requirements, and market practices. GEICO navigated these changes by strengthening its government relations capabilities and adapting its business practices to comply with evolving regulations while maintaining its competitive positioning. Analysis: how this period of crisis and recovery shaped GEICO's approach to risk and growth. The tumultuous period from 1958 to 1993 profoundly influenced GEICO's corporate DNA, establishing patterns and principles that continue to guide the company today. The near collapse in the mid-1970s served as a powerful cautionary tale about the dangers of undisciplined growth and inadequate risk management. This experience instilled a more conservative approach to expansion that would characterize GEICO's strategy even during its subsequent periods of rapid growth. The crisis also reinforced the fundamental importance of underwriting discipline, the careful selection and pricing of risks, to the viability of GEICO's low-cost business model. Without the local knowledge and personal assessment that traditional agents provided, GEICO needed to develop more sophisticated data analysis and risk evaluation systems. This necessity drove technological innovation and eventually positioned the company advantageously for the digital age. GEICO's recovery demonstrated the resilience of its core business concept. Despite critics who claimed the direct-to-consumer model had been proven unworkable, the company's successful restructuring showed that the approach remained viable when properly executed. This vindication strengthened institutional commitment to the direct model and encouraged further innovations to enhance its effectiveness. The introduction of 24/7 telephone service in 1980 represented a pivotal adaptation of the direct-to-consumer concept. By providing round-the-clock accessibility, GEICO addressed one of the primary criticisms of its model: the lack of immediate personal assistance that agents offered. This innovation established a pattern of using technology to overcome the limitations of the direct model while preserving its cost advantages. Perhaps most significantly, this period cemented Warren Buffett's relationship with GEICO. His investment during the company's darkest hour not only provided needed capital, but also connected GEICO with Buffett's long-term investment philosophy. This relationship would eventually culminate in Berkshire Hathaway's complete acquisition of GEICO, fundamentally altering the company's ownership structure and strategic orientation. By 1993, as Olza Tony Nicely assumed leadership as chairman, president, and CEO, GEICO had completed its recovery and established a solid foundation for future growth. The company had approximately 3 million policyholders, a far cry from its current 16 million, but had proven the viability of its business model through both prosperity and adversity. The lessons learned during this period about disciplined underwriting, technological innovation, careful expansion, and financial conservatism would inform GEICO's approach as it entered its next phase of dramatic growth under Nicely's leadership and, eventually, Berkshire Hathaway's ownership. 4. The Berkshire Hathaway era begins, 1993-2019. The appointment of Olza Tony Nicely as GEICO's chairman, president, and CEO in 1993 marked the beginning of a transformative period in the company's history. Over the next 2.5 decades, GEICO would evolve from a mid-sized, specialized insurer into a dominant force in the American auto insurance market. This remarkable transformation was driven by several interconnected developments. Nicely's aggressive growth strategy, Warren Buffett's complete acquisition of the company through Berkshire Hathaway, revolutionary marketing approaches, and digital innovation. Together, these factors propelled GEICO to unprecedented success, while simultaneously establishing patterns that would eventually lead to significant internal contradiction. Tony Nicely's appointment as CEO and his four-company strategy. Tony Nicely was in many ways the ideal leader to guide GEICO into its next phase of development. Having joined the company in 1961 as an investment clerk, Nicely had risen through the ranks over more than 3 decades, gaining intimate knowledge of GEICO's operations, culture, and competitive positioning. His career spanned the company's rapid growth in the 1960s, its near collapse in the mid-1970s, and its subsequent recovery and stabilization. This experience gave him a nuanced understanding of both GEICO's potential and its vulnerabilities. Upon assuming leadership, Nicely implemented what became known as the four-company strategy. This approach involved creating distinct insurance operations under the GEICO umbrella, each targeting different customer segments based on risk profiles. GEICO Preferred Insurance Company served the lowest risk drivers with the best rates. GEICO Casualty Company provided coverage for drivers with moderate risk factors at somewhat higher premiums. GEICO General Insurance Company and GEICO Indemnity Company rounded out the structure, serving other market segments with appropriate pricing. This stratified approach represented a sophisticated evolution of the Goodwin's original concept of targeting specific customer groups. Rather than limiting GEICO to only the safest drivers, as it had done during its recovery from the 1970s crisis, the four-company strategy allowed for broader market penetration while maintaining appropriate risk-based pricing. It enabled GEICO to grow its customer base substantially without compromising underwriting discipline, a delicate balance that had proven elusive in the past. Nicely complemented this structural innovation with a significant increase in GEICO's advertising budget. Recognizing that the direct-to-consumer model required greater investment in brand awareness than agent-based competitors, he authorized expanded marketing efforts across multiple channels. This increased visibility began to attract more customers, creating positive momentum that would accelerate dramatically after Berkshire Hathaway's acquisition. Warren Buffett and the Berkshire Hathaway acquisition, 1996. Warren Buffett's relationship with GEICO had deep historical roots by the time he engineered Berkshire Hathaway's complete acquisition of the company in 1996. His connection began in 1951, when as a 21-year-old student of Benjamin Graham at Columbia University, Buffett traveled to Washington on a Saturday to learn more about GEICO. Finding the office closed, he was fortunate to encounter Lorimer Davidson, who spent several hours explaining the company's business model. Impressed by what he heard, Buffett made his first purchase of GEICO stock. This initial investment was followed by a much larger one in 1976, when Buffett acquired approximately 1 million shares during GEICO's financial crisis. This purchase, representing a significant vote of confidence in the company's underlying business model, despite its temporary difficulties, helped stabilize GEICO during its darkest hour. By 1980, Berkshire Hathaway owned 33% of GEICO, making it the largest shareholder, but still leaving the company publicly traded and independently managed. Buffett's decision to acquire the remaining shares of GEICO in 1995 to 1996 reflected his long-standing admiration for the company's business model and his confidence in Tony Nicely's leadership. The acquisition process was remarkably straightforward by corporate standards. In August 1995, Berkshire Hathaway made an offer of $70 per share for the remaining outstanding stock, a generous premium over the market price. By early 1996, the transaction was complete, making GEICO a wholly owned subsidiary of Berkshire Hathaway at a total cost of approximately $2.3 billion. This acquisition aligned perfectly with Buffett's investment philosophy. He had long expressed a preference for businesses with sustainable competitive advantages or moats, and GEICO's direct-to-consumer model provided precisely such an advantage through lower operating costs. Buffett also favored companies with straightforward, understandable business models and strong management teams, both characteristics that GEICO possessed. Perhaps most importantly, the insurance industry's float, the premiums collected before claims are paid, provided capital that Buffett could deploy for other investments, making insurance companies particularly valuable within the Berkshire Hathaway structure. The impact of Berkshire Hathaway's ownership on GEICO was profound and multifaceted. Most immediately, it provided access to substantial capital resources that could fund accelerated growth. Buffett authorized a dramatic increase in GEICO's advertising budget from approximately $31 million in 1995 to over $200 million by 2000, and eventually to more than $1 billion annually. This massive investment in brand awareness would have been impossible for GEICO as an independent public company facing quarterly earnings pressures. Beyond financial resources, Berkshire Hathaway's ownership brought a distinctive management philosophy. Buffett was famous for acquiring well-run companies and then allowing their leadership teams to operate with minimal interference. This approach gave Tony Nicely and his team unusual freedom to pursue long-term growth strategies without the short-term pressures typical of publicly traded companies. It also reinforced GEICO's existing culture of operational autonomy and entrepreneurial initiative. Perhaps most significantly, Berkshire Hathaway's ownership provided GEICO with unparalleled financial stability. The parent company's extraordinary financial strength, AAA credit rating at the time, and diversified business holdings meant that GEICO could weather economic downturns and catastrophic events without liquidity concerns. This stability allowed for more aggressive growth strategies and competitive pricing than would have been prudent for an independent insurer with more limited resources. The marketing revolution. The most visible manifestation of GEICO's transformation under Berkshire Hathaway ownership was its revolutionary marketing approach. With Buffett's blessing and Nicely's direction, GEICO embarked on what would become one of the most successful and recognizable advertising campaigns in American business history. This marketing revolution began modestly but quickly expanded into a multi-channel, multi-character extravaganza that fundamentally altered both GEICO's public image and the insurance advertising landscape. The GEICO Gecko made his first appearance during the 2000 television season. Created partly in response to frequent mispronunciations of the company name, often confused with Gecko, the character quickly transcended his original purpose to become an advertising icon. With his charming British accent, voiced initially by Kelsey Grammer and later by Jake Wood, and friendly, approachable demeanor, the Gecko humanized an otherwise mundane financial service. He presented GEICO as helpful, unthreatening, and slightly quirky, a stark contrast to the staid, serious image projected by most insurance companies at the time. The Gecko was soon joined by other memorable characters and campaigns. In 2004, GEICO introduced the cavemen in response to its "So easy, a caveman can do it" slogan. These sophisticated, sensitive cavemen, offended by GEICO's supposedly insensitive slogan, created a humorous narrative that extended across multiple commercials and even spawned a short-lived television series. The Cavemen campaign cleverly addressed potential customer concerns about the complexity of buying insurance directly while reinforcing the message of simplicity. Other notable characters and concepts followed. Maxwell the Pig with his wee 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 excitement about Geico's mobile app. The rhetorical Did You Know campaign featuring surprising facts paired with Geico's savings message. The Geico pothole personified as a malevolent character. And perhaps most famously, the Hump Day Camel celebrating Wednesday with infectious enthusiasm. Each of these campaigns maintained consistent messaging about Geico's core value propositions: savings, simplicity, and service, while using humor and memorable characters to break through advertising clutter. This multi-character approach was innovative in several respects. Rather than relying on a single advertising concept that might eventually grow stale, Geico created a portfolio of characters and campaigns that could run simultaneously across different media channels. This strategy allowed the company to reach diverse demographic groups with tailored messaging while maintaining overall brand consistency. It also created a sense of surprise and anticipation. Viewers never knew which Geico character might appear in the next commercial. The scale of Geico's advertising presence was unprecedented in the insurance industry. By the early 2010s, the company was spending over $1 billion annually on advertising, far exceeding competitors' budgets. This massive investment created a virtuous cycle. Increased advertising drove customer growth, which generated additional premium revenue, which funded even more advertising. Geico's messages became ubiquitous across television, radio, print, digital media, and outdoor advertising, creating extraordinary brand awareness. The marketing revolution extended beyond traditional advertising to include innovative sponsorships and promotional activities. Geico sponsored sporting events, venues, and teams across the country. The Gecko embarked on national tours, appearing at zoos and aquariums to promote wildlife conservation efforts. The company created interactive websites for characters like the cavemen, extending their narratives beyond commercial breaks. These activities further embedded Geico in American popular culture and reinforced its friendly, approachable brand image. Digital transformation and market position gains. Parallel to its marketing revolution, Geico underwent a significant digital transformation that enhanced its direct-to-consumer business model. The company had already embraced telephone technology with its 24/7 service introduced in 1980, but the rise of the internet and mobile computing presented new opportunities to improve customer acquisition and service while further reducing costs. Geico launched its first website in the mid-1990s, initially offering basic company information and contact details. By the late 1990s, the site had evolved to provide online quotes, allowing potential customers to price Geico policies without speaking to a representative. This capability perfectly complemented the company's increased advertising, creating a seamless path from awareness through commercials to consideration via online quotes to purchase. The digital transformation accelerated in the 2000s with the introduction of online policy management, electronic document delivery, and web-based claims reporting. These innovations improved customer convenience while reducing Geico's operational costs, a win-win that reinforced the fundamental advantage of the direct-to-consumer model. By eliminating paper processing, reducing call center volume, and streamlining workflows, Geico was able to maintain its cost advantage over traditional insurers, even as it grew rapidly. In 2010, Geico achieved another industry first by enabling customers to quote and buy policies from mobile-friendly pages on their iPhone and Android devices. This innovation recognized the growing importance of mobile computing and positioned Geico at the forefront of insurance technology. The company followed with dedicated mobile apps that expanded functionality beyond purchasing to include policy management, claims reporting, and roadside assistance requests. These digital innovations contributed significantly to Geico's remarkable market position gains during this period. From 1996 to 2019, the company grew from approximately 3.7 million policies to over 17 million. Its market share in the private passenger auto insurance segment increased from less than 3% to approximately 14%, moving Geico from the seventh largest auto insurer to the second largest, behind only State Farm. This growth was not merely a function of marketing and technology, but also reflected GEICO's competitive pricing. The company's lower expense ratio, operating costs as a percentage of premiums, allowed it to offer rates that were often 15% or more below those of agent-based competitors while maintaining profitability. As consumers became increasingly price-sensitive and comfortable with direct purchasing, GEICO's value proposition became more compelling. Employee experience during this period. While GEICO's external success during the Berkshire Hathaway era was undeniable, the internal employee experience presented a more complex picture. The company's rapid growth created thousands of new jobs across its expanding network of regional offices, call centers, and claims operations. This growth offered career advancement opportunities for many employees and brought the excitement of being part of a visibly successful enterprise. GEICO was known during this period for its generous profit-sharing plan, which averaged approximately 18% of salary annually. This substantial benefit helped compensate for base salaries that were sometimes lower than industry averages and created a sense of shared success as the company grew. The profit-sharing structure aligned employee interests with company performance, encouraging a focus on both growth and profitability. The company culture under Tony Nicely emphasized operational excellence, customer service, and cost efficiency. Employees were expected to maintain high performance standards, particularly in customer-facing roles, where metrics like call handling time, customer satisfaction scores, and sales conversion rates were closely monitored. This performance-oriented culture could be demanding but also created clarity about expectations and recognition for achievement. GEICO's workplace environment during this period reflected a blend of traditional and progressive elements. The company maintained relatively conventional office structures and work schedules, with most employees working on-site during standard business hours. However, it also invested in employee development programs, wellness initiatives, and community involvement activities that fostered engagement and loyalty. The employee experience varied significantly across different parts of the organization. Claims adjusters, sales representatives, and customer service agents typically faced the most intense performance pressures and metrics-driven management. Corporate functions like marketing, finance, and IT generally experienced more flexible working conditions and less direct performance monitoring. Regional offices developed their own subcultures within the broader GEICO framework, leading to variations in management style and workplace atmosphere. Despite these variations, certain common themes characterized the GEICO employee experience during this era. The company offered stability and predictability in an increasingly volatile job market. It provided clear career paths with opportunities for advancement based on performance, and it maintained a distinct corporate identity that many employees found appealing, a blend of financial conservatism, operational discipline, and quirky marketing creativity. Analysis: how Berkshire Hathaway's ownership transformed GEICO while maintaining certain core elements. The period from 1993 to 2019, encompassing Tony Nicely's leadership and the first 2 decades of Berkshire Hathaway ownership, represented a remarkable transformation for GEICO. The company evolved from a mid-sized, specialized insurer into a market leader with national brand recognition and massive market share. Yet throughout this transformation, certain core elements of GEICO's identity remained intact, creating both continuity and tension. The direct-to-consumer business model established by the Goodwins not only survived but thrived during this period. What had once been considered an unconventional approach became increasingly mainstream as consumer preferences shifted towards self-service and digital interaction. GEICO's early commitment to this model positioned it advantageously for these changing preferences, while Berkshire Hathaway's resources allowed for the technological investments necessary to fully realize the model's potential. The focus on cost efficiency also persisted, though its manifestation evolved significantly. The Goodwins' frugality had been born of necessity in the challenging economic environment of the 1930s. Under Berkshire Hathaway, GEICO maintained this cost consciousness, but applied it selectively, spending lavishly on advertising and technology while maintaining tight control over other operational expenses. This selective efficiency created a distinctive business model that combined high visibility with low operating costs. GEICO's targeting of specific customer segments, another founding principle, evolved into the more sophisticated four-company strategy under Nicely. Rather than limiting itself to the safest drivers, GEICO developed the capability to price appropriately across a broader risk spectrum. This evolution maintained the underlying principle of risk-based pricing while enabling much greater market penetration. Perhaps most significantly, the emphasis on growth that had characterized GEICO's early decades returned with renewed vigor under Berkshire Hathaway ownership. The near collapse of the 1970s had temporarily dampened this growth orientation, but Buffett's long-term perspective and substantial resources allowed GEICO to pursue aggressive expansion without the financial vulnerabilities that had previously led to crisis. These continuities amid transformation created a complex corporate identity, one that honored GEICO's heritage while embracing dramatic change. This complexity would eventually manifest in tensions and contradictions, particularly as leadership transitioned from Tony Nicely to Todd Combs in 2020. The marketing-driven, growth-oriented culture that had developed under Nicely and Buffett would face new challenges in a changing competitive landscape, setting the stage for the cultural upheaval that would characterize the company's most recent chapter. The Todd Combs Era, Cultural Upheaval, 2020 present. The appointment of Todd Combs as GEICO's CEO in January 2020 marked the beginning of a significant cultural and operational shift for the company. Coming from a background in investment management rather than insurance operations, Combs brought a different perspective and priorities to GEICO's leadership. His tenure has coincided with extraordinary external challenges, most notably the COVID-19 pandemic, and has been characterized by controversial internal changes that have altered the company's relationship with its employees. This period represents perhaps the most dramatic divergence between GEICO's friendly public image and its internal practices, revealing tensions that had been building beneath the surface during the company's rapid growth. Combs' appointment as CEO and background. Todd Combs came to GEICO through an unusual path that reflected Warren Buffett's distinctive approach to succession planning at Berkshire Hathaway. Unlike Tony Nicely, who had risen through GEICO's ranks over decades, Combs joined Berkshire Hathaway in 2010 as an investment manager. His primary responsibility was managing a portion of Berkshire's investment portfolio, a role in which he performed well enough to earn Buffett's confidence. Combs' background was in financial analysis and hedge fund management rather than insurance operations. After earning his MBA from Columbia Business School, coincidentally Buffett's alma mater, he had worked at Progressive Insurance in a limited analytical capacity before founding Castle Point Capital, a hedge fund focused on financial services companies. This experience gave him sophisticated understanding of insurance economics from an investor's perspective, but limited direct exposure to the operational complexities of running an insurance company. Buffett's decision to appoint Combs as GEICO's CEO in January 2020 reflected several considerations. First, at 89 years old, Buffett was actively planning for Berkshire Hathaway's future leadership. Giving Combs operational experience at GEICO would broaden his capabilities and potentially prepare him for larger responsibilities within Berkshire. Second, GEICO was facing increasing competitive pressure, particularly from Progressive, which had made significant technological advances in telematics and usage-based insurance. Combs' familiarity with Progressive might help GEICO respond to these challenges. Third, after decades of remarkable growth under Tony Nicely, who remained as chairman, GEICO might benefit from fresh perspective as it entered a more mature phase of its development. The transition occurred with Buffett's characteristic lack of fanfare. In a brief press release on December 23, 2019, Berkshire Hathaway announced that Combs would assume the CEO role on January 1, 2020, while continuing his investment management responsibilities. Nicely would remain as executive chairman, providing continuity and institutional knowledge during the transition. The announcement emphasized that Combs would work closely with Bill Roberts, GEICO's president, and the rest of the GEICO team, suggesting a collaborative approach to leadership. Leadership transition during the COVID-19 pandemic. Combs' tenure as CEO began just weeks before the COVID-19 pandemic transformed American society and the auto insurance industry. The pandemic's impact on driving patterns was immediate and dramatic. Stay-at-home orders, remote work arrangements, and business closures led to substantially reduced driving, resulting in fewer accidents and claims. This sudden change created both opportunities and challenges for auto insurers. The industry's response to these unprecedented conditions varied, but most major insurers, including GEICO, provided premium refunds or credits to policyholders in recognition of the reduced risk exposure. GEICO announced a 15% credit for auto and motorcycle policies renewed between April 8 and October 7, 2020, representing approximately $2.5 billion in savings for customers. This response, while significant, was criticized by some consumer advocates as insufficient given the dramatic reduction in driving and claims. Beyond the immediate financial implications, the pandemic created operational challenges that tested Combs' leadership during his first months as CEO. GEICO needed to rapidly transition thousands of employees to remote work arrangements while maintaining customer service levels. Claims processes had to be adapted to minimize in-person contact. Sales and marketing strategies required adjustment to reflect changing consumer needs and sensitivities during a public health crisis. These extraordinary circumstances made it difficult to distinguish between pandemic-related adaptations and changes driven by Combs' leadership philosophy. Some operational decisions that might have generated resistance in normal times were accepted as necessary pandemic responses. Conversely, the disruption caused by COVID-19 may have provided cover for more controversial changes that aligned with Combs' vision for GEICO, but departed from established practices. The pandemic also accelerated certain industry trends that were already underway, particularly the shift toward digital interaction and remote operations. GEICO had been investing in these capabilities for years, but COVID-19 forced a more rapid and comprehensive adoption of digital processes. This acceleration aligned with Combs' background in financial technology and may have facilitated changes he would have pursued even without the pandemic catalyst. Major policy and cultural changes. As Combs settled into his leadership role and the initial shock of the pandemic subsided, a series of policy changes emerged that signaled a significant shift in GEICO's approach to employee relations and operational management. These changes, implemented over 2021 and 2022, represented a departure from long-standing practices and generated considerable controversy within the organization. Perhaps the most consequential change was the elimination of GEICO's profit-sharing plan in February 2022. This program, which had averaged approximately 18% of salary annually, had been a cornerstone of GEICO's compensation structure and employee relations for decades. It provided a significant financial benefit that helped offset base salaries that were sometimes lower than industry averages. The profit-sharing plan also created a sense of shared purpose and aligned employee interests with company performance. The sudden replacement of this established program with a less generous cash bonus system came as a shock to many long-term employees who had built their financial planning around the expected profit-sharing payments. After employee pushback, GEICO eventually settled on a 6% 401k match in January 2023. But this still represented a substantial reduction in total compensation for most employees compared to the previous arrangement. Concurrent with these compensation changes, GEICO implemented workforce reductions and repositioning initiatives. The company closed all 38 of its California offices in 2022, affecting approximately 2,500 employees. While some were offered the opportunity to continue working remotely or relocate to other states, Many positions were eliminated. Similar office closures and staff reductions occurred in other regions, though less dramatically than in California. Many employees who remained with the company found themselves forced into new positions, often with different responsibilities and performance expectations. These repositionings were presented as necessary adaptations to changing business conditions, but they created significant disruption and uncertainty within the workforce. The process was described by some employees as lacking transparency and consideration for individual circumstances or preferences. The pandemic-driven shift to remote work initially appeared to offer a silver lining amid these challenging changes. Many employees appreciated the flexibility and work-life balance that remote arrangements provided. However, in 2023, GEICO reversed course on this policy, requiring employees to return to the office 2 days per week, beginning July 10th. This mandate came despite earlier promises to continue remote work if certain performance goals were met, further eroding trust between leadership and employees. These policy changes were accompanied by shifts in management approach and communication style. Under Combs' leadership, GEICO adopted more aggressive performance metrics and monitoring practices, particularly in customer-facing roles. The emphasis on efficiency and productivity intensified, with some employees reporting increased pressure to meet targets with fewer resources. Internal communications became more formal and less personal, reflecting a move away from the family-like culture that had characterized GEICO for much of its history. Employee response and unionization efforts. The cumulative impact of these changes generated unprecedented employee dissatisfaction and ultimately the first serious attempt to unionize GEICO's workforce. In mid-2022, employees in the Amherst, New York office launched GEICO United, a unionization campaign that quickly gained momentum and spread to other locations. This effort represented a remarkable development for a company that had maintained largely harmonious labor relations throughout its history, and in an industry with minimal union presence. The unionization drive was led by long-term employees who felt that the company culture and employee treatment had fundamentally changed under Combs' leadership. Lonnie Konikoff, a 15-year GEICO employee in Amherst, articulated this sentiment. Things weren't the same. People were treated very poorly. They started letting people go, and we started piling up losses, and you could see that the people that Todd put in place around him have a very different vision of GEICO than what many of us have seen for all these years. The elimination of profit sharing served as the catalyst for the union effort, but organizers cited broader concerns about job security, working conditions, and management practices. They pointed to increased workloads, aggressive performance metrics, and a general deterioration in the employment relationship. The union campaign gained many hundreds of signatories according to organizers, though exact numbers were not disclosed. GEICO's response to the unionization effort reflected the more adversarial approach that had emerged under Combs. The company sent emails to employees discouraging unionization, emphasizing the costs of union dues and characterizing the organizers as a third party, despite their status as GEICO employees. According to union activists, management at one point advised employees to call the police on union representatives going door to door, an unusually aggressive anti-union tactic. The conflict escalated to the point that New York state legislators sent a letter to GEICO in September 2022, warning the company to refrain from union-busting activities. The National Labor Relations Board began investigating a complaint filed in February 2023, alleging that GEICO had fired an employee for engaging in protected concerted activity under Section 7 of the National Labor Relations Act. These developments represented a dramatic departure from GEICO's historical employee relations approach and created a public relations challenge that contrasted sharply with the company's friendly advertising persona. The unionization effort received coverage in industry publications and local media, potentially damaging GEICO's reputation as an employer and raising questions about its corporate values. Financial performance under Combs. GEICO's financial performance during Combs' tenure has been volatile, reflecting both the extraordinary external circumstances of the pandemic and the internal changes implemented under his leadership. The company experienced significant underwriting losses in 2021 and 2022, followed by a partial recovery in 2023. The pandemic initially created favorable conditions for auto insurers as reduced driving led to fewer accidents and claims. However, as driving patterns began to normalize in late 2020 and 2021, GEICO faced challenging dynamics. Inflation drove up the cost of auto repairs, replacement parts, and medical treatments, increasing the average cost per claim. Supply chain disruptions extended repair times, leading to higher rental car expenses for policyholders. Labor shortages in auto repair shops further complicated claims resolution. These external factors contributed to GEICO's $1.9 billion pre-tax underwriting loss in 2022, a shocking reversal for a company that had been consistently profitable for decades. This performance lagged behind some competitors, particularly Progressive, which adapted more quickly to the changing conditions through sophisticated pricing algorithms and telematics data. Combs responded to these financial challenges with a multifaceted approach. He implemented significant cost-cutting measures, including the workforce reductions and office closures mentioned earlier. GEICO reduced its advertising spending, a notable departure from the marketing-driven strategy of the Nicely era. The company also raised premiums substantially in many states to address the gap between claims costs and premium revenue. These measures began to show results in early 2023, when GEICO reported $703 million in earnings for the first quarter. Higher average premiums and lower advertising spending contributed to this improvement, though claim frequencies also decreased during this period. While this performance represented progress, it remained well below the consistent profitability levels GEICO had achieved under previous leadership. The financial volatility during Combs' tenure raised questions about the long-term viability of his approach. Critics argued that the cost-cutting measures, while improving short-term financial results, might damage GEICO's competitive position and growth potential. The reduction in advertising spending, in particular, represented a significant strategic shift for a company that had built its market position through ubiquitous marketing presence. Defenders of Combs' approach countered that he faced unprecedented challenges that required difficult decisions. They pointed to the improvement in 2023 results as evidence that his strategy was working, albeit with painful adjustments. From this perspective, Combs was making necessary corrections to a business model that had become unsustainable in the face of changing market conditions and competitive dynamics. Analysis: how leadership change catalyzed significant cultural shifts. The transition from Tony Nicely to Todd Combs as CEO represents more than a routine leadership change. It signifies a fundamental shift in GEICO's organizational culture and strategic orientation. This transition illuminates how leadership philosophy can transform a company's internal dynamics, even while its external brand remains relatively consistent. Several factors contributed to the magnitude of this cultural shift. First, Combs' background in investment management rather than insurance operations brought a different perspective to GEICO's leadership. His approach emphasized financial analysis and shareholder value over the operational and customer service focus that had characterized Nicely's tenure. This shift in emphasis manifested in policy changes that prioritized short-term financial performance over employee satisfaction and long-term relationship building. Second, the timing of the transition during the COVID-19 pandemic created both cover and justification for dramatic changes. The extraordinary circumstances of the pandemic allowed for more radical departures from established practices than might have been possible during normal times. The disruption to traditional work arrangements and business operations created a context in which change became expected rather than exceptional. Third, the generational distance between Nicely and Combs influenced their leadership approaches. Nicely had joined GEICO in 1961 and risen through the ranks during an era when long-term employment relationships were the norm and companies often functioned as social institutions. as well as economic enterprises. Combs, by contrast, developed his career during a period of increasing financialization of the American economy, when shareholder value often took precedence over other stakeholder interests. These different formative experiences shaped their respective visions for GEICO's culture and operations. The cultural shift under Combs reveals tensions that had been latent within GEICO for years. The company's remarkable growth under Berkshire Hathaway ownership had been achieved through a combination of aggressive marketing, technological innovation, and operational efficiency. This growth-oriented strategy required substantial investment and accepted higher expense ratios than might have been optimal from a short-term profitability perspective. Combs' approach prioritized profitability over growth, exposing the trade-offs inherent in GEICO's previous strategy. Similarly, the elimination of profit sharing highlighted the tension between employee interests and financial performance metrics. The profit-sharing program had aligned these interests by giving employees a direct stake in the company's success. Its replacement with a less generous 401k match signaled a shift toward viewing employees more as costs to be managed than as partners in the enterprise. This change reflected a broader trend in American corporate culture toward treating labor as a fungible input rather than a source of competitive advantage. The unionization effort sparked by these changes represents perhaps the most significant cultural shift of all. For most of its history, GEICO had maintained a paternalistic but generally positive relationship with its workforce, offering stability, career advancement opportunities, and financial benefits that fostered loyalty and commitment. The emergence of organized labor activism indicates a fundamental breakdown in this relationship and a transition to a more adversarial dynamic between management and employees. This cultural upheaval under Combs' leadership has created the most stark contradiction yet between GEICO's external brand image and its internal reality. While the friendly Gecko continues to appear in commercials promising savings and service, employees report experiences of cost-cutting, increased pressure, and deteriorating work conditions. This disconnect raises questions about the sustainability of GEICO's brand promise and the long-term implications of its cultural transformation. 6. GEICO's public image, the friendly Gecko. Few corporate mascots have achieved the level of cultural recognition and affection that the GEICO Gecko enjoys. This friendly, articulate lizard with his charming British accent has become not merely a marketing device, but a pop culture icon, instantly recognizable to millions of Americans. The Gecko represents the culmination of GEICO's sophisticated approach to brand building, an approach that has transformed a once obscure insurance company into one of the nation's most recognizable brands. This section examines how GEICO constructed its distinctive public image, the messages embedded in its advertising, and the effectiveness of this carefully crafted persona in driving business growth. Evolution of GEICO's advertising strategy. GEICO's journey to advertising prominence began in earnest after Berkshire Hathaway's acquisition in 1996, when Warren Buffett authorized a dramatic increase in marketing spending. Prior to this period, the company's advertising had been relatively modest and straightforward, focusing primarily on its direct-to-consumer model and potential savings for government employees and other preferred customer groups. The transformation of GEICO's advertising approach under Berkshire Hathaway ownership represents one of the most successful marketing pivots in American business history. The creation of the GEICO Gecko in 2000 marked a watershed moment in this evolution. The character was initially conceived as a practical solution to a specific problem. People frequently mispronounced GEICO as Gecko. The first Gecko commercial, which aired during the 2000 Screen Actors Guild strike when using human actors was challenging, featured the character approaching a microphone at a press conference to clarify that he was a gecko, not to be confused with GEICO. This simple premise quickly evolved into something much more significant as marketers recognized the character's potential. The Gecko's development over time reflects sophisticated character building and brand strategy. Initially voiced by actor Kelsey Grammer with a refined, somewhat stuffy British accent, the character later evolved to have a more approachable working-class British accent provided by English actor Jake Wood. His personality developed from somewhat pompous to friendly, helpful, and slightly bemused by human behavior. This evolution made the character more relatable while maintaining his distinctive charm and memorability. The Gecko's success inspired GEICO to expand its character portfolio with the introduction of the cavemen in 2004. These sophisticated, sensitive cavemen, offended by GEICO's "so easy, a caveman can do it" slogan, created a humorous narrative that extended across multiple commercials. The Cavemen campaign cleverly addressed potential customer concerns about the complexity of buying insurance directly while reinforcing the message of simplicity. The campaign's popularity led to a short-lived ABC television series in 2007, demonstrating the remarkable cultural penetration GEICO's advertising had achieved. Other memorable characters and campaigns followed. Maxwell the Pig, with his wee excitement about GEICO's mobile app. The rhetorical "Did you know?" campaign, featuring surprising facts paired with GEICO's savings message. The GEICO pothole personified as a malevolent character, and the Hump Day Camel celebrating Wednesday with infectious enthusiasm. Each of these campaigns maintained consistent messaging about GEICO's core value propositions while using humor and memorable characters to break through advertising clutter. This multi-character approach represented a significant innovation in advertising strategy. Rather than relying on a single concept that might eventually grow stale, GEICO created a portfolio of characters and campaigns that could run simultaneously across different media channels. This approach allowed the company to reach diverse demographic groups with tailored messaging while maintaining overall brand consistency. It also created a sense of surprise and anticipation. Viewers never knew which GEICO character might appear in the next commercial. The scale of GEICO's advertising presence became unprecedented in the insurance industry. By the early 2010s, the company was spending over $1 billion annually on advertising, far exceeding competitors' budgets. This massive investment created a virtuous cycle. Increased advertising drove customer growth, which generated additional premium revenue, which funded even more advertising. GEICO's messages became ubiquitous across television, radio, print, digital media, and outdoor advertising, creating extraordinary brand awareness. Marketing messages and brand promises. Beneath the humor and memorable characters, GEICO's advertising consistently communicated several core messages that defined the company's brand promises to consumers. The most prominent of these was the famous slogan, "15 minutes could save you 15% or more on car insurance," which appeared in virtually all GEICO marketing from the early 2000s onward. This message emphasized both savings, the 15% or more, and convenience, just 15 minutes, addressing the two primary concerns of insurance shoppers. The savings message aligned perfectly with GEICO's business model. By eliminating agent commissions and operating with lower overhead costs, the company genuinely could offer lower premiums to many customers. The specific claim of 15% or more was carefully worded to be defensible. Some customers would indeed save that much or more, though not all would. This message positioned GEICO as the value option in a category where price sensitivity was increasing, particularly during economic downturns. The convenience message, 15 minutes, addressed a potential concern about direct-to-consumer insurance, that without an agent, the process might be complicated or time-consuming. By promising a quick, easy experience, GEICO reassured potential customers that direct purchasing could be more convenient, not less, than the traditional agent model. This message became increasingly relevant as consumer preferences shifted towards self-service and digital interaction. Beyond these explicit messages, GEICO's advertising conveyed implicit brand promises through tone and character. The Gecko's friendly, helpful demeanor suggested that GEICO itself would be approachable and easy to work with. The humor throughout the company's advertising created an impression of a brand that didn't take itself too seriously. a refreshing contrast to the often staid, serious tone of traditional insurance marketing. This approachability and lightheartedness became central to Geico's brand identity. Geico's advertising also emphasized technological innovation and accessibility. Commercials highlighting the company's website, mobile app, and 24/7 service availability positioned Geico as a modern, convenient option. These messages reinforce the direct-to-consumer value proposition, while addressing potential concerns about service availability without local agents. The consistent portrayal of Geico as technologically advanced helped the company appeal to younger, more digital-savvy consumers. Notably absent from most Geico advertising was detailed discussion of coverage options, policy features, or claims handling processes. While competitors often emphasized protection, security, and being there in times of need, Geico focused primarily on the purchasing experience and initial price. This emphasis reflected the company's understanding of consumer decision-making in auto insurance, where price often drives initial selection, while service quality becomes relevant only when claims arise. Corporate citizenship and public relations. Beyond its advertising campaigns, Geico cultivated its public image through corporate citizenship initiatives and strategic public relations. The company maintained a particular focus on military and government employee communities, honoring its historical roots while building goodwill among these important customer segments. Geico regularly sponsored military appreciation events, offered special discounts for active duty and retired military personnel, and participated in hiring programs for veterans. The Geico Philanthropic Foundation, established in 1975, provided another vehicle for public image building through charitable giving. The foundation focused on education, particularly supporting scholarships and academic programs in insurance, business, and mathematics. It also contributed to health research, safety initiatives, and community development projects in areas where Geico maintained significant operations. These philanthropic activities generated positive publicity while reinforcing the company's image as a responsible corporate citizen. Environmental initiatives represented another dimension of Geico's public relations strategy. The company promoted paperless policies and electronic communications as environmentally friendly options, aligning ecological messaging with cost-saving operational practices. The Gecko character occasionally appeared at zoos and aquariums to promote wildlife conservation efforts, creating a thematic connection between the mascot and environmental causes. Geico also built its public image through sports sponsorships and entertainment partnerships. The company sponsored NASCAR teams, professional sports venues, and collegiate athletic programs across the country. These sponsorships increased brand visibility while associating Geico with popular entertainment experiences. The ubiquity of Geico branding at sporting events reinforced the company's image as a mainstream, all-American brand despite its specialized origins. In its public relations messaging, Geico emphasized its longevity and stability, particularly its connection to Warren Buffett and Berkshire Hathaway. This association provided credibility and reassurance about the company's financial strength, important considerations for consumers purchasing a financial product like insurance. Geico's communications highlighted its growth milestones and industry rankings, positioning the company as a success story and market leader rather than an alternative or niche option. Analysis: the construction of Geico's public persona and its effectiveness. Geico's public image represents one of the most successful brand construction projects in modern American business. Through consistent, massive investment in advertising and strategic public relations, the company transformed itself from a specialized insurer with limited name recognition into a cultural touchstone with near-universal awareness. This transformation facilitated Geico's remarkable growth from the seventh-largest auto insurer in the 1990s to the second-largest today. The effectiveness of Geico's public persona stems from several key factors. First, the company identified and consistently communicated messages that addressed primary consumer concerns in auto insurance, price, and convenience. Rather than attempting to compete on coverage details or claim service promises, GEICO focused relentlessly on the factors that most influenced initial purchasing decisions. Second, GEICO pioneered the use of humor in insurance advertising, creating a distinctive voice in a category previously characterized by serious, sometimes fear-based messaging. This approach not only differentiated GEICO from competitors, but also made its advertising more engaging and memorable. Consumers looked forward to GEICO commercials as entertainment, not merely as marketing messages to be endured. Third, the company's multi-character strategy created remarkable flexibility and longevity for its advertising approach. When one character or campaign began to lose effectiveness, GEICO could shift emphasis to others without abandoning its overall brand identity. This portfolio approach allowed for continuous refreshment of the advertising message while maintaining consistency in the underlying brand promises. Fourth, GEICO's massive advertising spending created a presence so ubiquitous that it became self-reinforcing. The frequency and breadth of GEICO messaging across multiple channels created a familiarity that bred trust rather than contempt. For many consumers, GEICO's omnipresence itself became a signal of the company's legitimacy and stability. The construction of this public persona was not merely creative, but strategic, addressing specific business challenges. The friendly, approachable Gecko helped compensate for the lack of personal relationships with local agents. The emphasis on ease and simplicity countered concerns about the direct-to-consumer model. The association with Berkshire Hathaway and Warren Buffett provided reassurance about financial stability without requiring detailed discussion of balance sheets or ratings. However, this carefully constructed public image also created expectations that would prove challenging to fulfill consistently in actual customer interactions. The friendly, helpful persona projected in advertising established a standard for customer experience that required significant operational excellence to deliver. The promise of simplicity and convenience created expectations that complex insurance processes, particularly claims handling, might not always meet. These gaps between image and reality would become increasingly apparent as GEICO grew, creating tensions that would eventually contribute to the contradictions examined later in this analysis. 7. Behind the curtain, GEICO's internal practices. While GEICO's public image projects friendliness, accessibility, and customer centricity, the company's internal practices reveal a more complex reality. Behind the charming Gecko and humorous advertising campaigns lies an organization driven by rigorous efficiency metrics, aggressive cost management, and sometimes controversial operational approaches. This section examines GEICO's actual business practices, particularly in claims handling, employee treatment, and diversity issues, revealing significant contradictions between the company's public persona and its operational realities. Claims handling controversies. At the heart of any insurance company's operations is its claims handling process, the moment when the promises made in marketing materials and policy documents are tested through actual customer experiences. GEICO's approach to claims handling has generated significant controversy and litigation, revealing practices that often contrast sharply with its friendly public image. The Harvey vs. GEICO case provides a particularly illuminating example of these contradictions. This Florida case, which resulted in a $9.2 million judgment against GEICO, exposed problematic claims handling practices that prioritized cost containment over policyholder protection. The case involved a GEICO-insured driver who caused an accident resulting in the death of another motorist. Despite clear liability and a policy limit of $100,000 that was far below the likely damages, GEICO failed to proactively settle the claim, exposing its policyholder to a substantial excess judgment. Evidence presented during the litigation revealed that GEICO's claims adjuster had failed to properly communicate with the insured about the claim status and had disregarded supervisor instructions regarding claim handling. The Florida Supreme Court found that GEICO had acted in bad faith by failing to fulfill its fiduciary duty to protect its policyholders' interests. This case highlighted a fundamental tension in GEICO's claims operation. The drive to minimize payouts sometimes undermined the company's obligation to protect its policyholders. This tension manifests in various claims handling tactics that legal experts and customer complaints have identified. GEICO, like other insurers but perhaps more aggressively, employs strategies designed to minimize claim payouts. These include recording statements that can later be used against claimants. GEICO adjusters routinely record conversations with claimants, often immediately after accidents when individuals may be confused, in pain, or emotionally distressed. These recordings can later be used to identify inconsistencies or statements that might reduce the company's liability. Eliciting potentially damaging information, adjusters are trained to ask questions that might reveal information helpful to GEICO's position, such as pre-existing medical conditions or admissions about partial responsibility for accidents. Downplaying injuries. Claims representatives sometimes minimize the severity of injuries or suggest that they resulted from pre-existing conditions rather than the accident in question. Making quick, low settlement offers. GEICO often presents settlement offers early in the claims process, before claimants have fully assessed their damages or consulted attorneys. These offers typically represent a fraction of what claimants might receive through more thorough negotiation or litigation. Delaying tactics. When quick settlements aren't accepted, GEICO sometimes employs various delay strategies, including slow response times, requests for unnecessary documentation, and extended investigation periods. These delays can pressure financially vulnerable claimants to accept lower settlements out of immediate need. These practices reflect a fundamental business reality. Every dollar saved on claims payments contributes directly to GEICO's profitability. The company's direct-to-consumer model, which eliminates agent commissions, creates pressure to find savings elsewhere in the operation. Claims payments represent the largest expense category for auto insurers, making them a natural target for cost containment efforts. GEICO has also faced criticism for its use of computerized claims assessment tools that some argue systematically undervalue claims. These systems use algorithms to calculate settlement offers based on various factors, including injury type, treatment costs, and geographic location. Critics contend that these automated systems fail to adequately account for individual circumstances and often produce offers below fair market value for injuries. Customer complaints about GEICO's claims handling frequently mention difficulties reaching adjusters, unreturned calls, lack of updates on claim status, and perceived low-ball settlement offers. These experiences contrast sharply with the accessible, helpful persona projected by the Gecko and other advertising characters. The gap between marketing promises of ease and simplicity and the often complex, adversarial reality of the claims process represents one of the most significant contradictions in GEICO's business model. Employee treatment issues. GEICO's internal contradictions extend beyond customer interactions to its treatment of employees. While the company's public image suggests a friendly, positive corporate culture, employee experiences reveal a more demanding, metrics-driven environment that has become increasingly challenging in recent years. The workplace environment at GEICO is characterized by rigorous performance monitoring and metrics-based management, particularly in customer-facing roles. Claims adjusters, sales representatives, and customer service agents typically operate under strict productivity targets that measure factors such as call handling time. Representatives are expected to complete customer interactions within specified time limits, creating pressure to move quickly through complex issues. Claims closure rates. Adjusters are evaluated partly on how quickly they close claims, potentially incentivizing hasty settlements over thorough investigation. Sales conversion rates. Sales representatives must convert a certain percentage of inquiries into policies, creating pressure to sell, even when products might not perfectly match customer needs. Customer satisfaction scores. While ostensibly focused on service quality, these metrics can create conflicting pressures when combined with efficiency targets. These performance metrics are monitored continuously through sophisticated tracking systems, creating what some employees describe as a stressful, high-pressure environment. Regular performance reviews focus heavily on these quantitative measures, with potential consequences for those who fail to meet targets consistently. The compensation changes implemented under Todd Combs' leadership have significantly impacted employee morale and financial well-being. The elimination of the profit-sharing plan, which had averaged approximately 18% of salary annually, represented a substantial reduction in total compensation for many employees. This change was particularly painful for long-term employees who had accepted lower base salaries in exchange for the expected profit-sharing benefits. Workforce reductions and repositioning initiatives have created additional stress and uncertainty. The closure of all 38 California offices in 2022, affecting approximately 2,500 employees, represented one of the most dramatic examples of these changes. Similar office closures and staff reductions occurred in other regions, though less extensively. Many employees who remained with the company found themselves forced into new positions, often with different responsibilities and performance expectations. The pandemic-driven shift to remote work initially appeared to offer a silver lining amid these challenging changes. Many employees appreciated the flexibility and work-life balance that remote arrangements provided. However, GEICO's subsequent reversal of this policy, requiring employees to return to the office 2 days per week beginning in July 2023, further eroded trust between leadership and employees. This mandate came despite earlier promises to continue remote work if certain performance goals were met. Employee testimonials, particularly from those involved in the unionization effort, describe a deteriorating workplace culture under recent leadership. Melissa Miller, a claim service representative who was fired after 5.5 years at GEICO, reported increasing performance pressures without adequate support. I explained to the judge that I have never been coached. I have never been warned. No written warning, no issues. I'm entitled to 20 to 30 minutes of coaching every week. I have not received that. I've never received that. Miller also described anti-union messaging during departmental meetings. I remember speaking to my supervisor in one of the meetings and saying, "For a company who is trying to convince me and trying to reassure me that I don't need a union, you're jamming this anti-union stuff so far down my throat, it's concerning me. It's making me feel like I actually need one because it's actually making me feel insecure in my position." These employee experiences reveal a significant disconnect between GEICO's friendly public image and the reality of its workplace environment. While the Gecko project's approachability and good humor, many employees describe an increasingly demanding, metrics-driven culture with diminishing benefits and job security. Discrimination allegations. GEICO has faced multiple discrimination allegations that further contradict its inclusive public image. These issues have manifested both in workplace practices and in business operations, raising questions about the company's commitment to diversity and equal treatment. In 2023, a class action lawsuit led by civil rights attorney Ben Crump alleged that GEICO systematically deprived minority business owners, GEICO field representatives, of critical business opportunities. The lawsuit claimed that approximately 67% of terminated agents in March 2023 were minorities, suggesting a potentially discriminatory pattern in business relationship decisions. This high-profile case followed numerous individual discrimination lawsuits filed by employees alleging various forms of discrimination, including age discrimination, claims that older employees were disproportionately affected by layoffs and faced barriers to advancement. Disability discrimination, allegations that GEICO failed to provide reasonable accommodations for employees with disabilities and discriminated against them in employment decisions. Racial discrimination, complaints about disparate treatment of minority employees in hiring, promotion, and disciplinary actions. Gender discrimination, claims of unequal pay and advancement opportunities for female employees. Beyond workplace issues, GEICO has faced scrutiny regarding potentially discriminatory pricing practices. Like many auto insurers, GEICO uses various non-driving factors in its rating models, including education level, occupation, credit score, and zip code. Critics argue that these factors can serve as proxies for race and socioeconomic status, potentially resulting in higher premiums for minority and low-income customers, despite similar driving records. The algorithmic nature of modern insurance pricing creates additional concerns about embedded biases that may be difficult to detect and address. As GEICO has increased its reliance on sophisticated data analysis and automated systems for underwriting and pricing, the potential for algorithmic discrimination has grown. This issue represents a particularly challenging contradiction for a company that markets itself as fair and customer-friendly. GEICO's response to these discrimination allegations has typically been defensive rather than reflective. The company has generally denied systematic discrimination while addressing individual cases through settlements that avoid admissions of wrongdoing. This approach has allowed GEICO to limit legal liability, but has not necessarily addressed underlying structural issues that might contribute to discriminatory outcomes. Data privacy and security challenges. In an increasingly digital business environment, data privacy and security have become critical concerns for insurance companies that collect and maintain sensitive personal information. GEICO has faced significant challenges in this area, most notably a 2021 data breach that exposed customers' driver's license numbers and other personal information. The breach, which occurred between November 2020 and March 2021, allowed unauthorized users to access customer information through GEICO's online sales system. The company notified affected customers in April 2021 and offered free credit monitoring services. But the incident raised questions about GEICO's data security practices and transparency. GEICO's handling of the breach reflected a tension between legal risk management and customer communication. The company's notifications were legally compliant but minimally informative, providing limited details about the scope of the breach, the number of affected customers, or the specific vulnerabilities that had been exploited. This approach prioritized limiting potential liability over comprehensive transparency. More broadly, GEICO's extensive data collection, practices for pricing and marketing purposes create ongoing privacy concerns. The company, like other insurers, gathers and analyzes vast amounts of personal information beyond driving records, including credit histories, shopping patterns, and social media activity. While these practices enable more sophisticated risk assessment and targeted marketing, they also raise questions about appropriate boundaries for data collection and usage. These data privacy and security challenges highlight another contradiction in GEICO's business model. The company's direct-to-consumer approach and digital transformation require extensive data collection and analysis, yet these very practices create vulnerabilities and concerns that can undermine customer trust, a critical asset for an insurer marketing itself as friendly and trustworthy. Analysis: the gap between public messaging and operational realities. The examination of GEICO's internal practices reveals significant gaps between the company's public messaging and operational realities. These gaps are not merely incidental, but reflect fundamental tensions within GEICO's business model and strategic positioning. The most profound contradiction lies in GEICO's simultaneous promises of lower prices and superior service. The direct-to-consumer model that enables GEICO's cost advantage necessarily eliminates the personalized service that traditional agents provide. While GEICO has attempted to compensate for this through technology and centralized customer service, the resulting experience often falls short of the friendly, helpful interaction suggested by the Gecko and other advertising characters. This contradiction is particularly acute in claims handling, where cost containment imperatives frequently conflict with service quality expectations. GEICO's aggressive approach to minimizing claim payouts may support its ability to offer lower premiums, but it creates customer experiences that contrast sharply with the company's friendly advertising persona. The resulting disappointment is magnified precisely because GEICO's marketing has set such high expectations for ease and helpfulness. Similarly, GEICO's employee treatment reflects tensions between cost efficiency and workplace quality. The metrics-driven management approach that helps maintain operational efficiency creates a high-pressure environment at odds with the company's lighthearted public image. The elimination of profit sharing and other benefit reductions under recent leadership have prioritized short-term financial performance over employee well-being, contradicting the company's public emphasis on relationships and community. The discrimination allegations against GEICO highlight another dimension of this gap between image and reality. While the company projects an inclusive, diverse image through its marketing, the lawsuits and complaints suggest potential systematic issues in how GEICO treats minority employees, business partners, and potentially customers. These contradictions raise questions about the depth of GEICO's commitment to the values implied by its public messaging. These gaps between messaging and reality are not unique to GEICO, but reflect broader tensions in corporate America between shareholder value maximization and stakeholder interests. However, the particular visibility of these contradictions at GEICO stems from the company's extraordinary investment in brand building and the specific promises embedded in its advertising. By creating such a distinctive, appealing public persona, GEICO has established expectations that its operational realities struggle to fulfill consistently. The resulting disconnect raises important questions about corporate authenticity and the ethics of modern marketing. To what extent can a company's public image diverge from its operational realities before crossing into misrepresentation? How should consumers evaluate the gap between advertising promises and actual experiences? These questions extend beyond GEICO to challenge fundamental assumptions about corporate communication and accountability in contemporary American business culture. 8. Key contradictions: image versus reality. The preceding sections have examined GEICO's history, growth, leadership transitions, public image, and internal practices. This comprehensive analysis reveals several fundamental contradictions between how GEICO presents itself to the public and how it actually operates. These contradictions are not merely incidental, but reflect deep tensions within the company's business model, strategic positioning, and corporate culture. This section synthesizes these findings to identify and analyze the key contradictions that define contemporary GEICO. Friendly persona versus aggressive business practices. Perhaps the most striking contradiction in GEICO's operations is the gap between its friendly, approachable advertising persona and its often aggressive business practices, particularly in claims handling. The GEICO Gecko projects warmth, helpfulness, and good humor, qualities that suggest a company that prioritizes customer relationships and satisfaction. This friendly character has become so central to GEICO's brand identity that many consumers associate these personality traits with the company itself. However, GEICO's actual business practices, especially in claims situations, often reflect a much more aggressive, adversarial approach. The company's claims handling strategies, including quick, low settlement offers, recorded statements that can be used against claimants, and tactics that can delay fair compensation, create experiences that contrast sharply with the helpful, customer-focused image projected in advertising. Legal cases like Harvey v. GEICO have exposed practices that prioritize minimizing payouts over protecting policyholders' interests, revealing a fundamental disconnect between brand promises and operational realities. This contradiction stems from competing imperatives within GEICO's business model. The company's direct-to-consumer approach requires substantial investment in advertising to generate brand awareness and customer acquisition in the absence of local agents. This advertising necessarily projects a friendly, appealing image to attract potential customers. Yet the same direct model creates pressure to control costs elsewhere in the operation, particularly in claims payments, which represent the largest expense category for auto insurers. The resulting tension places GEICO in a difficult position. Its marketing success depends on creating positive expectations about the customer experience, but its financial performance depends partly on managing claims costs in ways that may disappoint those same expectations. This contradiction becomes particularly acute during claim situations, precisely when customers most need the friendly, helpful service promised by the Gecko. Customer savings versus cost cutting at employee expense. GEICO's famous slogan, 15 minutes could save you 15% or more on car insurance, places customer savings at the center of its value proposition. This message has been remarkably consistent throughout the company's modern marketing history, establishing price advantage as GEICO's primary competitive differentiator. The implication is that GEICO's operational efficiency allows it to pass savings on to customers while maintaining quality service and appropriate coverage. However, recent years have revealed a more complex reality behind these customer savings. Under Todd Combs's leadership, GEICO has implemented significant cost-cutting measures that have primarily affected employees rather than improving operational efficiency. The elimination of the long-standing profit-sharing plan, which had averaged approximately 18% of salary annually, represented a substantial reduction in employee compensation. This change, along with workforce reductions, office closures, and forced repositioning of many employees, suggests that customer savings may increasingly come at the expense of employee well-being, rather than through genuine efficiency improvements. This contradiction raises important questions about the sustainability of GEICO's value proposition. If customer savings are achieved primarily through reducing employee compensation and benefits, the resulting workplace dissatisfaction may eventually undermine service quality and operational effectiveness. The unionization effort sparked by these changes indicates that employees are increasingly unwilling to accept deteriorating conditions, potentially forcing GEICO to either raise prices or find alternative efficiency measures to maintain profitability. More broadly, this contradiction reflects tensions in the relationship between shareholder value and stakeholder interests in contemporary American business. GEICO's status as a wholly owned subsidiary of Berkshire Hathaway creates pressure to deliver consistent financial returns, particularly as the parent company's overall performance has become more dependent on operating businesses rather than investment gains. This pressure may be driving short-term cost-cutting measures that could undermine long-term competitive positioning. Ease and simplicity versus complex claims processes. A central theme in GEICO's advertising is the ease and simplicity of doing business with the company. From the "so easy, a caveman can do it" campaign to the 15 minutes promise, GEICO consistently portrays itself as offering a straightforward, hassle-free insurance experience. This messaging directly addresses a common consumer concern about insurance: that it is complicated, confusing, and difficult to navigate without expert assistance. In reality, GEICO's processes, particularly for claims handling, can be anything but simple. Customers frequently report difficulties reaching adjusters, unreturned calls, requests for extensive documentation, and complex settlement negotiations. The absence of local agents means that customers must navigate these processes through centralized call centers or digital interfaces, often speaking with different representatives at each interaction, rather than developing a relationship with a single point of contact. This complexity serves strategic purposes within GEICO's business model. Complex claims processes can discourage some claimants from pursuing full compensation, reduce the likelihood of claimants securing legal representation, and create opportunities for the company to minimize payouts. From a business perspective, these outcomes support profitability, but they directly contradict the ease and simplicity promised in GEICO's advertising. The contradiction becomes particularly problematic because GEICO's marketing has set such high expectations for simplicity. Customers who select GEICO based partly on these promises may feel especially disappointed when confronted with complex, sometimes adversarial claims processes. This gap between expectations and reality can damage customer satisfaction and loyalty, potentially undermining the very growth that GEICO's marketing is designed to generate. Stability and trustworthiness versus internal upheaval. GEICO's brand, project stability and trustworthiness, qualities that are particularly important in the insurance industry, where customers are essentially purchasing a promise of future protection. The company's association with Warren Buffett and Berkshire Hathaway reinforces this image, as does its emphasis on longevity, operating since 1936, and consistent growth. The Gecko himself presents a reassuring, reliable persona that suggests a company customers can count on. Behind this stable facade, however, GEICO has experienced significant internal upheaval in recent years. The transition from Tony Nicely to Todd Combs as CEO brought dramatic changes to the company's operational approach and corporate culture. The elimination of profit sharing, workforce reductions, office closures, and forced repositioning of employees have created an environment of uncertainty and instability for many within the organization. The emergence of unionization efforts, unprecedented in GEICO's history, further indicates the depth of this internal turbulence. This contradiction between projected stability and internal upheaval creates several challenges for GEICO. Employees experiencing workplace instability may struggle to deliver the consistent, high-quality service that customers expect. The resulting service inconsistencies can undermine the trustworthiness that GEICO's brand promises. More fundamentally, this contradiction raises questions about the authenticity of GEICO's brand messaging, whether the company truly embodies the values it projects or merely presents them as marketing devices. The stability contradiction also reflects broader tensions in the relationship between corporate image and operational reality in American business. Companies increasingly invest in sophisticated brand building while simultaneously implementing efficiency measures that may undermine the very qualities their brands promise. This disconnect between image and reality creates vulnerabilities that may become more apparent as stakeholders, including customers, employees, and regulators, demand greater corporate authenticity and transparency. Inclusive, diverse image versus discrimination allegations. GEICO's marketing presents a modern, inclusive company that values diversity. Its advertising features diverse casts, and its public communications emphasize commitment to equal opportunity and fair treatment. This inclusive image aligns with contemporary social values and helps position GEICO as a progressive, forward-thinking organization, despite its long history and traditional industry. However, multiple discrimination lawsuits and the recent class action, led by civil rights attorney Ben Crump, suggest potential systemic issues with diversity and inclusion at GEICO. The lawsuits claim that approximately 67% of terminated agents in March 2023 were minorities, raises serious questions about the company's commitment to equal treatment in business relationships. Individual discrimination lawsuits alleging age, disability, racial, and gender discrimination further contradict GEICO's inclusive public image. Beyond explicit discrimination allegations, GEICO's use of non-driving factors in its rating models, including education level, occupation, credit score, and zip code, raises concerns about potential disparate impact on minority and low-income customers. These factors can serve as proxies for race and socioeconomic status, potentially resulting in higher premiums for disadvantaged groups despite similar driving records. The algorithmic nature of modern insurance pricing creates additional concerns about embedded biases that may be difficult to detect and address. This contradiction between inclusive messaging and discrimination allegations reflects broader challenges in American corporate culture regarding diversity and inclusion. Many companies have embraced diversity in their marketing and public communications without necessarily addressing structural issues that may perpetuate inequality within their organizations and business practices. This gap between rhetoric and reality creates reputational risks as stakeholders increasingly demand authentic commitment to the values companies publicly espouse. Innovation in marketing versus traditional workplace policies. GEICO has demonstrated remarkable innovation in its marketing approaches, pioneering the use of humor in insurance advertising, developing a portfolio of memorable characters and campaigns, and effectively leveraging digital channels to reach consumers. This marketing innovation has been central to GEICO's growth and competitive positioning, establishing the company as a creative force in an industry often perceived as staid and conventional. In contrast to this forward-thinking marketing, GEICO has maintained relatively traditional workplace policies, particularly under recent leadership. The company's return to office mandate in 2023, requiring employees to work on-site 2 days per week, despite earlier promises to continue remote arrangements, represents a reversion to conventional workplace models at a time when many organizations are embracing greater flexibility. This traditional approach extends to performance management, with heavy emphasis on quantitative metrics and close monitoring of employee activities. This contradiction between innovative marketing and traditional workplace policies reflects a selective approach to innovation, embracing new ideas in customer-facing aspects of the business while maintaining conventional practices internally. This selectivity may limit GEICO's ability to attract and retain top talent, particularly as workplace expectations evolve and employees increasingly value flexibility and autonomy. It also creates potential disconnects between the creative, progressive image projected to customers and the more traditional reality experienced by employees. More broadly, this contradiction highlights questions about the depth of innovation in American corporations. Companies may adopt surface-level innovation in highly visible areas like marketing while maintaining traditional approaches in core operational practices. This selective innovation may limit organizational adaptability and resilience in the face of changing market conditions and stakeholder expectations. Analysis: the strategic purpose and business consequences of these contradictions. The contradictions identified above are not merely incidental, but serve specific strategic purposes within GEICO's business model. Understanding these purposes helps explain why the contradictions persist despite their potential negative consequences. The friendly persona versus aggressive business practices. Contradiction enables GEICO to attract customers through appealing advertising while maintaining profitability through strict claims management. This approach maximizes customer acquisition while minimizing the most significant expense category for auto insurers. The resulting financial performance has supported GEICO's remarkable growth and contributed significantly to Berkshire Hathaway's overall results. Similarly, the customer savings versus cost-cutting at employee expense contradiction allows GEICO to deliver on its core value proposition of lower premiums while maintaining profit margins. By reducing employee compensation and benefits, the company can continue offering competitive pricing even as claims costs rise due to inflation, supply chain disruptions, and other external factors. This approach prioritizes customer acquisition and retention over employee satisfaction and stability. The ease and simplicity versus complex claims processes. Contradiction serves GEICO's financial interests by encouraging initial purchases through promises of convenience while preserving opportunities to manage claims costs through procedural complexity. This contradiction effectively separates the purchasing experience, designed for maximum simplicity, from the claims experience, where complexity can benefit the company financially, allowing GEICO to optimize each process for different objectives. These strategic purposes help explain why GEICO has not resolved these contradictions, despite their potential negative consequences. The contradictions are not merely failures of execution, but integral components of the company's business model and competitive strategy. Resolving them would require fundamental changes to GEICO's approach, changes that might threaten the financial performance that has made the company so successful. However, these contradictions also create significant business risks that may threaten GEICO's long-term competitive position. The gap between advertising promises and actual customer experiences can damage satisfaction and loyalty, particularly as social media and review platforms make it easier for disappointed customers to share their experiences. The deteriorating employee experience may lead to service quality issues, increased turnover, and potentially successful unionization that could fundamentally alter GEICO's cost structure and operational flexibility. More fundamentally, these contradictions create vulnerability to competitors who can better align their public image with operational realities. Companies that deliver more consistently on their brand promises may build stronger customer relationships and loyalty, even if their initial acquisition costs are higher. This alignment between image and reality may become increasingly important as consumers demand greater authenticity and transparency from the companies they do business with. The persistence and consequences of these contradictions raise important questions about the sustainability of GEICO's current approach. Can the company continue to maintain its growth and profitability while these gaps between image and reality widen? Will increasing employee dissatisfaction and potential unionization force changes to the business model? How might evolving consumer expectations regarding corporate authenticity affect GEICO's market position? These questions will shape GEICO's future trajectory and determine whether its remarkable success story continues or faces significant challenges in the years ahead. GEICO in context, industry practices, and corporate America. GEICO's contradictions between public image and internal practices do not exist in isolation. They reflect broader patterns in the auto insurance industry and American corporate culture more generally. This section places GEICO's approach in context, comparing it with industry peers and examining how it exemplifies larger trends in contemporary business practices. This contextual analysis helps us understand the extent to which GEICO's contradictions are exceptional versus typical of modern corporate America. Comparison with other major auto insurers. GEICO operates in a highly competitive auto insurance market dominated by several large players with different business models and approaches. Comparing GEICO with its primary competitors, particularly State Farm, Progressive, Allstate, and USAA, reveals both industry-wide patterns and GEICO's distinctive characteristics. State Farm, the market leader with approximately 16% market share, employs a traditional agent-based model that contrasts sharply with GEICO's direct-to-consumer approach. State Farm's network of over 19,000 exclusive agents provides personalized service and local presence, but creates higher operating costs that must be reflected in premiums. The company's marketing emphasizes reliability, community connection, and being there like a good neighbor during difficult times. This messaging aligns more closely with State Farm's actual business model than GEICO's advertising does with its operations, as the agent relationship genuinely does provide more personalized service than GEICO's centralized approach. Progressive, GEICO's most direct competitor in terms of business model and market positioning, has pioneered technological innovation in auto insurance, particularly through its usage-based insurance programs like Snapshot. Like GEICO, Progressive employs a direct-to-consumer approach, though it also sells through independent agents, creating a hybrid distribution model. Progressive's marketing, featuring the character Flo, employs humor similar to GEICO's, but places greater emphasis on transparency and fairness, including its Name Your Price tool that allows customers to see how coverage changes affect premiums. This transparency-focused messaging better aligns with Progressive's actual practices than GEICO's friendly, helpful persona does with its operations. Allstate combines elements of both models, selling through exclusive agents while also offering direct purchasing through its Esurance brand, though this was phased out in 2020. Allstate's "You're in good hands" messaging emphasizes protection and security rather than savings or simplicity. This protection-focused messaging creates different customer expectations than GEICO's approach, potentially reducing the perception gap when claims processes prove complex or adversarial. USAA, which serves military members and their families, consistently receives the highest customer satisfaction ratings in the industry. Its restricted membership model allows for genuine community building and service customization that aligns with its messaging about understanding and serving the unique needs of military families. This alignment between messaging and operations creates stronger customer relationships and loyalty than GEICO's more contradictory approach. In claims handling practices, all major insurers employ strategies to manage costs, including recorded statements,
quick settlement offers, and computerized claims assessment tools. However, the extent and aggressiveness of these practices vary. GEICO's approach appears to be among the more aggressive in the industry, particularly in minimizing payouts and contesting claims. This aggressiveness may partly reflect the pressure to maintain profitability despite lower premium revenue per policy than agent-based competitors.
Employee treatment also varies across the industry. While all major insurers have implemented efficiency measures and performance metrics, GEICO's recent changes under Todd Combs, particularly the elimination of profit sharing and aggressive workforce reductions, appear more dramatic than industry norms. Progressive, for instance, has maintained a more stable approach to employee compensation and benefits while achieving comparable growth and profitability. In marketing investment, GEICO stands out for its massive advertising budget, which exceeded $1 billion annually at its peak. This extraordinary investment, approximately $250 per policy, creates particular pressure to convert advertising impressions into sales, potentially contributing to the gap between marketing promises and operational realities. Other insurers, with more modest advertising budgets relative to their size, may face less pressure to create such appealing but potentially misleading brand personas. This comparative analysis suggests that while certain contradictions exist throughout the auto insurance industry, GEICO's particular combination of massive marketing investment, aggressive claims practices, and recent employee relations changes creates especially pronounced gaps between image and reality. These gaps are not inevitable consequences of the direct-to-consumer model, as demonstrated by competitors who have achieved better alignment between their messaging and operations. Broader trends in American corporate culture. GEICO's contradictions exemplify several broader trends in contemporary American corporate culture, particularly regarding the relationship between public image and internal practices. These trends have accelerated in recent decades as companies have invested more heavily in brand building while simultaneously implementing efficiency measures that may undermine the very qualities their brands promise. The evolution of employer-employee relationships represents one of the most significant shifts in American business culture. The post-World War II era was characterized by relatively stable employment relationships, with many companies offering long-term job security, defined benefit pension plans, and predictable career progression. This model began to erode in the 1980s with the rise of shareholder primacy as the dominant corporate governance philosophy, accelerated in the 1990s with waves of downsizing and restructuring, and has continued to evolve toward increasingly transactional relationships. GEICO's recent changes under Todd Combs, eliminating profit sharing, implementing workforce reductions, and forcing employee repositioning, reflect this broader trend toward treating labor as a cost to be minimized rather than an asset to be developed. The company's reversal of remote work policies, despite employee preferences, similarly demonstrates the asymmetrical power dynamic in contemporary employment relationships. These changes are not unique to GEICO, but represent an acceleration of industry and economy-wide patterns. The growing gap between corporate messaging and internal practices extends beyond the insurance industry to virtually all sectors of the economy. Companies increasingly invest in sophisticated brand building that projects values like sustainability, diversity, community involvement, and employee well-being. Simultaneously, many of these same companies implement operational practices that contradict these projected values, cost-cutting that undermines service quality, workforce reductions that damage employee morale, and efficiency measures that prioritize short-term financial performance over long-term relationship building. This disconnect has been facilitated by the professionalization and expansion of corporate marketing and public relations functions. Companies now employ teams of specialists dedicated to crafting and maintaining public images that may bear little resemblance to operational realities. The resulting corporate personas function almost as fictional characters, like GEICO's Gecko, that can project appealing qualities regardless of whether the organization actually embodies them.
The role of private equity and investment-driven management has accelerated these trends. As financial considerations have become increasingly dominant in corporate decision-making, the pressure to deliver consistent short-term results has intensified. This pressure often leads to cost-cutting measures that contradict public messaging about quality, service, and employee well-being. While GEICO is not private equity owned, Todd Combs' background in hedge fund management reflects this financially oriented approach to corporate leadership. Digital transformation has created both new opportunities and new challenges regarding the alignment of image and reality. On one hand, digital channels allow companies to project carefully crafted images more widely and consistently than ever before. On the other hand, social media and review platforms make it easier for customers and employees to share their actual experiences, potentially exposing contradictions between messaging and reality. This dynamic creates an arms race between corporate image management and stakeholder truth-telling that shapes how companies like GEICO navigate their public personas. The Warren Buffett paradox. Warren Buffett's role in GEICO's story presents a particularly interesting paradox that reflects broader tensions in American business culture. Buffett has cultivated a public image as the quintessential ethical capitalist, the Oracle of Omaha, who combines extraordinary financial success with folksy wisdom and moral integrity. His annual letters to Berkshire Hathaway shareholders emphasize long-term thinking, fair dealing, and treating employees and customers well. This persona has made Buffett one of the most admired business leaders in American history. However, the operational realities at GEICO and other Berkshire Hathaway subsidiaries sometimes contradict the values Buffett publicly espouses. The aggressive claims handling practices, recent employee compensation reductions, and workforce cuts at GEICO seem at odds with Buffett's stated philosophy of treating stakeholders fairly and building businesses for the long term. This contradiction raises questions about the depth of Buffett's commitment to the values he projects and the extent of his actual involvement in subsidiary operations. The Buffett paradox reflects a broader tension in American business between the ideals of stakeholder capitalism and the realities of shareholder primacy. Buffett has publicly criticized the short-term focus of many corporate leaders and advocated for considering the interests of all stakeholders. Yet Berkshire Hathaway's performance is ultimately measured by its ability to deliver returns to shareholders, creating pressure that may filter down to subsidiaries like GEICO in ways that prioritize financial results over other considerations. This tension has become more pronounced as Berkshire Hathaway has evolved from primarily an investment vehicle to a conglomerate with significant operating businesses. The company's financial performance increasingly depends on the results of these operating subsidiaries rather than investment gains, potentially increasing pressure on subsidiary leaders to deliver consistent profits. Todd Combs' appointment as GEICO CEO, given his background in investment management rather than insurance operations, may reflect this financially oriented approach to subsidiary management. The Buffett paradox also highlights the challenges of maintaining consistent values across a large, diversified organization. Berkshire Hathaway's decentralized management philosophy gives subsidiary leaders significant autonomy, allowing for variations in approach that may not always align with Buffett's stated values. This decentralization creates space for contradictions between the parent company's projected image and the operational realities at individual subsidiaries. Analysis: how GEICO exemplifies larger contradictions in American business. GEICO's contradictions between public image and internal practices exemplify larger tensions in contemporary American business culture. These contradictions are not merely failures of execution, but reflect fundamental challenges in reconciling competing imperatives within the modern corporation. The tension between shareholder value and stakeholder interests represents perhaps the most significant of these challenges. Companies face intense pressure to deliver consistent financial returns to shareholders while simultaneously addressing the needs and expectations of customers, employees, communities, and other stakeholders. When these interests conflict, as they often do, shareholder considerations typically prevail, creating gaps between stakeholder-focused messaging and shareholder-oriented practices. GEICO's experience under Berkshire Hathaway ownership illustrates how this tension can evolve over time. During the high-growth period under Tony Nicely's leadership, GEICO maintained a relatively balanced approach that delivered shareholder value while also providing competitive compensation to employees and generally satisfactory experiences to customers. As growth slowed and competitive pressures intensified, the balance shifted under Todd Combs toward more aggressive prioritization of financial performance, widening the gap between messaging and practices. The contradiction between short-term results and long-term sustainability represents another fundamental tension in American business. Companies face pressure to deliver consistent quarterly performance while also building enduring competitive advantages and stakeholder relationships. When these time horizons conflict, short-term considerations often dominate, potentially undermining the very qualities that enable long-term success. GEICO's recent changes under Todd Combs, particularly the elimination of profit sharing and aggressive cost-cutting, may improve short-term financial results while potentially damaging employee morale, service quality, and organizational culture in ways that could threaten long-term competitive positioning. This prioritization of immediate financial performance over long-term relationship building reflects a broader pattern in American business culture. The tension between operational efficiency and service quality presents a particularly challenging contradiction for service businesses like GEICO. Companies must control costs to maintain profitability while delivering experiences that meet or exceed customer expectations. When these imperatives conflict, companies often attempt to maintain the appearance of high-quality service while implementing efficiency measures that actually reduce service levels. GEICO's direct-to-consumer model inherently creates this tension, as the elimination of local agents reduces costs, but also removes a personal service element that many customers value. The company has attempted to compensate for this through technology and centralized customer service, but the resulting experience often falls short of the friendly, helpful interaction suggested by the Gecko and other advertising characters. These larger contradictions in American business are not easily resolved, as they reflect fundamental tensions within the capitalist system itself. Companies must generate profits to survive and grow, but the pursuit of profit can sometimes undermine the very qualities that make them valuable to society: fair treatment of stakeholders, long-term sustainability, and authentic relationships. GEICO's experience illustrates both the prevalence of these contradictions and their potential consequences for organizational performance and reputation. The future of GEICO: challenges and possibilities. As GEICO approaches its 90th anniversary, the company faces a complex set of challenges and opportunities that will shape its future trajectory. The contradictions between its public image and internal practices, the changing competitive landscape in auto insurance, and broader shifts in consumer expectations and technology all present significant strategic considerations. This section examines GEICO's current position and the potential paths forward as it navigates these challenges. Current market position and competitive threats. GEICO currently holds a strong market position as the second-largest private passenger auto insurer in the United States, with approximately 14% market share. This represents remarkable growth from its position as the seventh-largest insurer when Berkshire Hathaway acquired full ownership in 1996. The company insures over 28 million vehicles through more than 16 million policies, generating annual premium revenue exceeding $37 billion. However, this strong position faces several significant competitive threats. Progressive, GEICO's most direct competitor in terms of business model, has demonstrated superior technological innovation, particularly in telematics and usage-based insurance. Progressive's Snapshot program, which collects driving data to offer personalized pricing, has given the company an advantage in risk assessment and pricing accuracy. GEICO has been slower to adopt similar technology, potentially placing it at a competitive disadvantage as these approaches become more widespread.
The rise of insurtech startups represents another competitive challenge. Companies like Root, Metromile, acquired by Lemonade, and ClearCover have entered the auto insurance market with fully digital business models, sophisticated data analytics, and customer experiences designed specifically for mobile-first consumers. While these startups currently hold small market shares, they appeal particularly to younger consumers who represent the future of the market and may be less attached to established brands like Geico. Traditional competitors are also evolving their approaches. State Farm has invested heavily in digital capabilities while maintaining its agent network, creating a hybrid model that offers both technological convenience and personal service. Allstate has expanded its direct-to-consumer capabilities while also investing in telematics and data analytics. These established players combine financial resources comparable to Geico's with increasingly sophisticated technological capabilities. Beyond these direct competitive threats, Geico faces broader challenges from changes in the auto insurance landscape. The gradual adoption of autonomous vehicle technology may eventually reduce accident frequency and severity, potentially shrinking the overall auto insurance market. The growth of ride-sharing and car-sharing services has already altered vehicle ownership patterns among younger consumers, creating new insurance needs that differ from traditional personal auto policies. The COVID-19 pandemic accelerated several trends that may permanently affect auto insurance, including increased remote work that reduces commuting miles, greater consumer comfort with digital interactions, and heightened price sensitivity due to economic pressures. These changes create both opportunities and challenges for Geico, requiring strategic adaptation to evolving consumer needs and expectations. Internal challenges. Geico's internal challenges are equally significant and may prove more immediately consequential for its competitive position. The employee relations issues that have emerged under Todd Combs's leadership, particularly the elimination of profit sharing, workforce reductions, and forced repositioning, have created unprecedented dissatisfaction within the organization. The resulting unionization effort represents a potential watershed moment for Geico, which has historically maintained non-union operations throughout its history. If the unionization effort succeeds, Geico would face a fundamentally altered relationship with its workforce. Collective bargaining would introduce new constraints on management decision-making regarding compensation, working conditions, and operational changes. The company's ability to implement rapid adjustments in response to market conditions would be reduced, potentially affecting its agility in a highly competitive industry. The financial implications could be significant, potentially increasing labor costs and reducing the cost advantage that has been central to Geico's competitive positioning. Even if formal unionization does not occur, the deterioration in employee morale and engagement presents serious operational challenges. Insurance remains a service business, despite increasing automation, and employee attitudes significantly impact customer experiences. Dissatisfied employees are less likely to deliver the friendly, helpful service promised in Geico's advertising, widening the gap between brand promises and customer experiences. Increased turnover can disrupt operational continuity and increase training costs, further affecting financial performance. Cultural recovery and rebuilding trust represent perhaps the most significant internal challenges facing Geico. The company's culture has undergone dramatic changes under Todd Combs's leadership, moving away from the stability and shared success that characterized the Tony Nicely era toward a more financially driven, efficiency-focused approach. Restoring a sense of shared purpose and mutual benefit between the company and its employees would require significant leadership commitment and potentially painful reconsideration of recent policy changes. Leadership succession planning presents another internal challenge. Todd Combs's appointment as CEO was part of Warren Buffett's broader succession planning for Berkshire Hathaway, with Combs potentially being groomed for larger responsibilities within the parent company. This creates uncertainty about Geico's future leadership and strategic direction. The company needs to develop internal leadership talent
that can provide stability and continuity regardless of potential changes at the top. The tension between GEICO's direct-to-consumer heritage and the need for technological innovation creates additional internal challenges. The company's historical strength has been operational efficiency in a relatively straightforward business model. As auto insurance becomes increasingly technology-driven and data-intensive, GEICO must develop new capabilities and potentially reshape its organizational structure and processes. This transformation requires significant investment and cultural adaptation that may prove challenging given the current internal turbulence. Potential paths forward. GEICO faces several potential paths forward as it navigates these external and internal challenges. Each path involves different strategic choices and trade-offs that will shape the company's future competitive position and organizational health. One potential path involves doubling down on the cost leadership strategy that has driven GEICO's historical success. This approach would continue to emphasize operational efficiency, aggressive claims management, and high-volume, low-cost customer acquisition through mass marketing. The recent cost-cutting measures under Todd Combs could be viewed as necessary adjustments to maintain this strategic positioning in an increasingly competitive market. This path prioritizes maintaining GEICO's price advantage over addressing the contradictions between its public image and internal practices. The viability of this path depends on several factors. First, can GEICO maintain employee productivity and service quality despite reduced compensation and increased workplace dissatisfaction? Second, will consumers continue to prioritize price over service quality and relationship consistency in their insurance purchasing decisions? Third, can GEICO's marketing maintain its effectiveness in attracting new customers, even as social media and review platforms make it easier for disappointed customers to share negative experiences? If these questions can be answered affirmatively, the cost leadership path may remain viable despite its internal contradictions. An alternative path involves reconciling GEICO's public image with its internal practices by bringing operations more in line with the friendly, helpful persona projected in advertising. This approach would require significant changes to claims handling practices, employee compensation and treatment, and potentially pricing strategy. It would prioritize authentic alignment between brand promises and customer experiences over short-term financial performance. This reconciliation path would involve several key elements. First, GEICO would need to restore employee morale and engagement through improved compensation, working conditions, and career development opportunities. This might include reinstating some form of profit sharing or implementing alternative incentive structures that align employee interests with company performance. Second, the company would need to modify claims handling practices to emphasize fair treatment and customer satisfaction rather than minimizing payouts. Third, GEICO would need to invest in service improvements that deliver on the ease and simplicity promised in its advertising. The financial implications of this path would be significant. Improved employee compensation and less aggressive claims management would increase costs, potentially requiring higher premiums or reduced marketing spending to maintain profitability. However, these changes might also reduce turnover, improve service quality, and enhance customer retention, creating offsetting financial benefits over the longer term. The key question is whether GEICO's leadership and Berkshire Hathaway would accept potentially reduced short-term profitability for greater long-term sustainability. A third potential path involves technological transformation to address competitive threats while maintaining GEICO's direct-to-consumer heritage. This approach would prioritize investments in telematics, artificial intelligence, advanced analytics, and digital customer experience to match or exceed Progressive's technological capabilities. It would position GEICO as an innovator rather than a follower in the evolving auto insurance landscape. This technological transformation path would require significant capital investment and organizational change. GEICO would need to recruit and develop talent in data science, software engineering,
and digital product management, areas where it has not historically been a leader. The company would need to balance its traditional focus on operational efficiency with the need for innovation and experimentation. This balance might be particularly challenging given the current cost-cutting emphasis under Todd Combs' leadership. The potential benefits of this path are substantial. Sophisticated telematics and usage-based insurance capabilities could improve risk assessment accuracy, allowing for more precise pricing that maintains competitiveness while improving profitability. Advanced analytics could enhance fraud detection and claims optimization, reducing costs without necessarily compromising customer experience. Digital service innovations could deliver on GEICO's promises of ease and simplicity while reducing operational expenses. A fourth potential path involves diversification beyond auto insurance to reduce dependence on this increasingly competitive market. GEICO already offers homeowners, renters, motorcycle, and other insurance products, but these represent a relatively small portion of its overall business compared to auto insurance. Expanding these offerings and developing true multi-policy capabilities could create new growth opportunities while strengthening customer relationships through bundled services. This diversification path would require GEICO to develop expertise and competitive advantages in markets where it has historically been a minor player. The company would need to determine whether its direct-to-consumer model and brand positioning transfer effectively to these adjacent markets or require modification. It would also need to consider whether organic growth or acquisitions represent the more effective approach to diversification. Analysis: GEICO's prospects for resolving its contradictions. GEICO's prospects for resolving the contradictions between its public image and internal practices depend on several factors, including leadership priorities, competitive pressures, and stakeholder expectations. The company's current trajectory under Todd Combs suggests limited interest in addressing these contradictions, with greater emphasis on financial performance than authentic alignment between messaging and operations. However, several forces may eventually compel greater attention to these contradictions. Employee dissatisfaction and potential unionization could force reconsideration of recent policy changes, particularly regarding compensation and working conditions. Customer feedback and social media criticism might create reputational damage that affects acquisition and retention. Competitive pressures from companies with better alignment between messaging and operations could erode GEICO's market position despite its massive advertising presence. Warren Buffett's eventual succession at Berkshire Hathaway represents another factor that could influence GEICO's approach to these contradictions. Buffett's successor may have different priorities and management philosophy, potentially affecting expectations for GEICO's financial performance and operational approach. This leadership transition could either exacerbate or alleviate the pressures that have widened the gap between GEICO's image and reality under current leadership. The most likely outcome is not complete resolution of these contradictions, but rather ongoing management of the tensions they create. GEICO will likely continue to project a friendly, helpful persona through advertising while maintaining relatively aggressive operational practices, but may make targeted adjustments to address the most visible and damaging disconnects. These adjustments might include modified claims handling procedures for the most sensitive cases, selective improvements in employee compensation and benefits, and enhanced digital services to deliver more consistently on promises of ease and simplicity. This pragmatic approach would not eliminate the fundamental contradictions in GEICO's business model, but might make them more sustainable by reducing their most negative consequences. It would represent an acknowledgement that some level of disconnect between image and reality is inherent in contemporary corporate operations, particularly in highly competitive industries where cost pressures and customer expectations create conflicting imperatives. GEICO's long-term success will depend on finding the right balance between these competing considerations, maintaining sufficient alignment between messaging and operations to preserve brand credibility while implementing necessary efficiency measures to remain competitive in a challenging market. This balancing act represents perhaps the central strategic challenge for GEICO as it approaches its 90th anniversary and navigates an increasingly complex business environment. A comprehensive analysis of America's second largest auto insurer. 11. Conclusion. The story of GEICO represents a remarkable American business journey, from a small, specialized insurer founded during the Great Depression to the nation's second-largest auto insurance company with a globally recognized brand. This transformation reflects both the power of innovative business models and the complex contradictions that can emerge as companies grow and evolve. GEICO's experience offers valuable insights, not only into the insurance industry, but also into broader patterns in American corporate culture and the relationship between public image and operational reality. GEICO's founding by Leo and Lillian Goodwin in 1936 established core principles that continue to influence the company today. The direct-to-consumer model that eliminated traditional insurance agents represented a revolutionary approach that reduced costs while creating new challenges in customer acquisition and service. The focus on carefully selected customer segments, initially government employees, demonstrated an early understanding of risk-based pricing that would become increasingly sophisticated over time. These founding innovations created a distinctive business identity that has persisted through decades of growth and change. The company's journey has not been without significant challenges. The financial crisis of the mid-1970s nearly destroyed GEICO, requiring painful restructuring and a return to underwriting discipline. This near-death experience reinforced the importance of risk management while demonstrating the fundamental viability of the direct-to-consumer model when properly executed. It also established Warren Buffett's relationship with GEICO through his timely investment during the company's darkest hour, a relationship that would eventually culminate in Berkshire Hathaway's complete acquisition. Under Tony Nicely's leadership and Berkshire Hathaway's ownership, GEICO achieved extraordinary growth from 1993 to 2019. The combination of aggressive marketing, digital innovation, and operational efficiency transformed the company from a mid-sized, specialized insurer into a market leader with national brand recognition. The creation of iconic advertising characters, like the GEICO Gecko, established one of the most recognizable corporate personas in American business history, driving customer acquisition and brand awareness to unprecedented levels. The more recent period under Todd Combs' leadership has revealed significant tensions within GEICO's business model and corporate culture. The elimination of profit-sharing, workforce reductions, and other cost-cutting measures have created unprecedented employee dissatisfaction, leading to the first serious unionization effort in the company's history. These changes have widened the gap between GEICO's friendly public image and its internal practices, creating contradictions that may threaten long-term competitive positioning despite short-term financial benefits. These contradictions are not unique to GEICO, but reflect broader tensions in contemporary American business culture. The gap between corporate messaging and operational reality has grown as companies invest more heavily in brand building while simultaneously implementing efficiency measures that may undermine the very qualities their brands promise. The prioritization of shareholder value over stakeholder interests has intensified these contradictions, creating challenges for companies attempting to balance financial performance with authentic relationships and sustainable practices. GEICO's experience also illuminates the evolution of the insurance industry from a relationship-based business dominated by local agents to an increasingly digital, data-driven marketplace. This transformation has created both opportunities and challenges for insurers, enabling greater efficiency and personalization, while potentially reducing the human connection that has historically characterized insurance relationships. GEICO's pioneering role in this transformation makes it a particularly instructive case study in industry evolution. Looking forward, GEICO faces a complex set of challenges and opportunities. The company must navigate increasing competitive pressure from both traditional insurers
and technology-driven startups, address internal employee relations issues that threaten operational stability, and manage the widening contradictions between its public image and business practices. Its success in addressing these challenges will depend on leadership choices, competitive dynamics, and broader trends in consumer expectations and technology.
The most fundamental question facing GEICO is whether it can maintain its remarkable growth and profitability while resolving, or at least managing, the contradictions between its friendly public persona and its operational realities. This question has no simple answer, as it reflects tensions inherent in the company's business model and in contemporary capitalism more broadly. The most likely outcome is not complete resolution, but rather ongoing management of these tensions, with targeted adjustments to address the most visible and damaging disconnects. GEICO's journey offers valuable lessons for business leaders, policymakers, and consumers. For business leaders, it demonstrates both the power of innovative business models and the challenges of maintaining authentic alignment between brand promises and operational realities. For policymakers, it raises important questions about corporate governance, consumer protection, and the changing nature of employment relationships. For consumers, it highlights the importance of looking beyond appealing advertising to understand the actual practices of the companies they do business with.
Perhaps most significantly, GEICO's story reveals the complex, sometimes contradictory nature of corporate evolution in modern America. Companies are not monolithic entities, but dynamic systems shaped by competing imperatives, changing leadership, and evolving market conditions. The friendly Gecko and the aggressive claims adjuster both represent authentic aspects of GEICO, reflecting the multifaceted reality of a complex organization navigating competing demands in a challenging business environment.
As GEICO approaches its 90th anniversary, its future remains unwritten. The company has demonstrated remarkable resilience and adaptability throughout its history, overcoming challenges that might have destroyed less robust organizations. Whether it can successfully navigate its current contradictions while maintaining competitive advantage in an evolving marketplace remains to be seen. What is certain is that GEICO's journey will continue to reflect broader patterns in American business culture, making it a fascinating case study in corporate evolution for years to come. Patterns in American business culture, making it a fascinating case study in corporate evolution for years to come.